I think the rally does have legs.
There is a slowdown that's underway, that there's no question, but I don't think people are positioned for it.
I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down.
There's a little bit of a fear in this higher for longer type environment that yields go even higher.
The risk is that the Fed is prematurely declaring victory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance. Good morning, good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK away. Looking at the leaves, I'm told. Bramo or something.
Like oh, yeah, he's
like
a big leaf peeper.
The start of fall, he likes to make it very official and go for a walk through the countryside. Whatever TK's up to, I'm told he's going to be back tomorrow. We need to talk about a new wrinkle in the soft landing dream. That wrinkle in the soft landing dream, $90 crude for the first time in 2023.
And you were asking the right question yesterday. Is it supply driven or demand driven? If it's demand driven, that means you're going to have that growth that's going to underpin some of the higher prices in commodities. If it's supply driven, what does that mean? Does that create more of a hiccup to the soft landing because you get just a higher commodity price without the growth?
Just as the likes of Governor Waller seems to put rate hikes on ice, two things: 10-year yields back near the highs of the year, dragged higher by extra supply coming from the credit side of things, and that rally in crude. I want to know how that's going to play out on this FOMC meeting a couple of weeks from today.
Yeah, how do they sort of signal? Are they going to be playing to a crude price, or are they going to be playing to a larger question? I think that my guess is you are as confused as I was trying to come up with a narrative yesterday with how high yields were going, just simply because there was this technical aspect that people were talking about, but it was accompanied with that stronger dollar. And then you could throw in the crude. Right now, it is such a muddle, it feels like, trying to put these pieces together. If it's technical, if it's something more longer lasting, if it's a last gasp of people saying higher yields for longer.
You mentioned that dollar strength. Let's talk about it. 8 straight weeks, 8 consecutive weeks of dollar strength on the dollar index. And now we're starting to see some pushback in Asia. 2 countries, 2 different responses, Lisa, China and Japan.
Okay, they're 2 very different responses, but they're both really highlighting the importance of why this rally is concerning in the dollar. And really, it has been a rally against other Asian currencies in particular. And that, I think, is notable. For Japan, it's creating this question of, okay, does this push them toward the end of yield curve control more quickly? And for China, this raises a question, do they want a weaker currency? What is the concern for not necessarily allowing their currency to depreciate? And then what kind of intervention are they actually willing to do when it's shown again and again that they aren't really willing to step in to the degree that people expect?
They're going to talk a little bit more. It's the first tool, isn't it? Verbal intervention. And then what?
Well, that's
Don't you need to
say.
see a change at the BOJ to actually put a floor under that currency?
Well, it didn't work. Let's just put it that way. The BOJ didn't work. They're talking and talking. And you know what? China is talking and talking, and it's not really working either. Because you know what? And then what is sort of the key thing? Is the Bank of Japan actually going to abandon yield curve control? Kind of doesn't seem like anytime soon. And then over in China, it doesn't seem like there's really the muscle or the will to do it.
You've got to see a policy move that changes the perception of where the fundamentals are going to be further down the road in the future. And right now, have we seen that policy move? In China, there's a hope we have on the property side of things. You've seen the rally.
Yeah.
The speculative, the frenzied rally in property developers in China overnight.
You buying it?
It's not for me to buy. I'm not selling it either.
No, but I'm saying, do you actually think it's longer lasting if they're going to step in and actually do something of substance?
We've seen something of substance recently. Whether we see more, whether we see stronger moves, I don't know. That's not my call. But I know there's people out there that have been fading that move consistently all year. Mislav Matejka over at JP Morgan in the investment bank has been one. And the people that have faded the move through much of this year have been rewarded for doing so. Over the last decade, though, if you've given China and that policymaker the benefit of the doubt, you've been rewarded over the long term for doing that.
There is a feel that they're pushing on a string. You can lower the barrier for people coming into housing for the first time. You can create easier financing. But at the end of the day, if people own more homes than they could potentially live in, and if you have empty cities, are you actually going to boost anything by simply manipulating a rate? And I think that's the issue, is that you're dealing with a very different structural moment in the Chinese economy. And I think that's what's causing a little bit of angst.
Just build more cities, seems to be the approach. Can they build more cities? Maybe they can.
A lot of people think not so much.
Okay. Equities on the S&P 500 look like this. Equities down by 0.2%. A little bit softer here. Yields of 425.19. We were backing away from 436 a few Tuesdays ago. And then all of a sudden, a sell-off in the Treasury market. Curious one on Friday. Payrolls, yeah, a little bit stronger, but unemployment higher. Participation rate better. And yet Treasuries still sold off. Tuesday, we get back to work. Treasuries carry on selling off. It's quite a move over 2 days on that 10-year yield.
It's the biggest move going back to, I believe, July. So if you look at just historically, even with some big moves, it is interesting that it's coming on the heels of supply. Here's what I'm watching today. There's a question of whether pause is the new hike, whether everyone is going to be signaling they're done. And the Bank of Canada meets at 10 a.m. and they tend to be out ahead of some of the other banks. And if they do pause at 5% and signal that they're done or really give that kind of rhetoric, could that shift some of the sentiment and maybe fade some of the shifts that we've seen in yields higher? 2 p.m. Fed's Beige Book is released, tracking the period through June 30th. Does anecdotal data confirm the strength that we're seeing in measures like the Atlanta Fed GDP now? Do we see that 6% GDP estimate really reflected in the anecdotal notes that we were hearing from Patrick Harker of the Philly Fed are probably more important than anything else? And today, central bank speak includes Bank of England's Andrew Bailey. He's speaking at 9:15 a.m. to Parliament. Also, Boston Fed President Susan Collins and Dallas Fed President Lori Logan. I love how they're all trying to sound hawkish, sort of, but their message is sort of the same, which is we can afford to pause. I'm not going to commit to anything, but, things are kind of, uncertain. I can't commit to anything. We don't know if we're done. I don't really know that we're actually gleaning anything from any of these commentaries.
When they say things like that, people start to think they are done. Perhaps they are done. Klaus Knot, the Dutch central bank governor, speaking to Bloomberg today, trying to reintroduce some two-way risk into the ECB meeting on September 14th, well aware that the guidance so far has led people to believe nothing's going to happen next week.
Okay, so I was reading that report and I was reading his comments. And my first comment is, wow, we actually have a hawk. And then you read further down and it's sort of, I'm not willing to commit to a rate hike. I'm not sure. So at a certain point, is he just trying to dress up the same message with a bit more of a hawkish wrapper?
Well, if the hawks can't be hawkish right now, what does that say about the decision?
Exactly. I think that's what people are.
The data was terrible in Germany.
It was terrible.
Factory orders were brutal. And for people who follow factory orders in Germany, it can be very, very volatile month on month. So this is going back to something like July. But still, terrible read of the German economy right now. And that data point, hardly isolated or unique, is it? It's been pretty poor across the board over the last few quarters.
Well, that's exactly where I was going to go. It's been not just for factory orders, but also now you're seeing services start to also really soften to a sub-expansionary level, raising some real questions.
Let's get to the conversation. It started this morning with Laurie Calvasina, head of US equity strategy over at RBC Capital Markets. Laurie, good morning to you. Let's start with that move in crude. Is that a wrinkle in the soft landing dream? Crude getting back to 90 again?
Well, thanks for having me as always, John. I think there are so many wrinkles right now. I think you can add this to a conflicting cross-current list. On the one hand, I think the last thing consumers need at this point in time, especially as we're heading into the student lending issue, which is engendering a lot of uncertainty on the street, is a spike in oil prices and gas prices. On the other hand, if we get the energy sector working, and I think that happens as oil prices move up, that does potentially spark a shift out of growth and back into value in more cyclical parts of the market. So I think wrinkle is definitely a good way to describe it.
Well, United Airlines might have a problem. Look at these numbers. Jet fuel prices climbing over 20% since the middle of July, seeing third quarter all-in fuel price from $2.95 to $3.05 a gallon. Bramo, this is going to hurt individual companies, particularly the airlines.
Well, and not just hurt, but also raise a question of, are they going to try to pass it along to consumers, right? These are sort of the knock-on effects of higher oil prices that could percolate into inflation more than just higher crude prices. Lori, do you see any challenge to the soft landing thesis in the price action, whether on the heels of higher crude prices or just because there is such acceptance of this beautiful Goldilocks scenario?
Well, one of the things we've been talking to clients about, the last few weeks, and got into a deep discussion about this with someone yesterday, is the buffers for consumers, I think, are far greater than people have anticipated. So I'm still in the soft landing kind of Goldilocks camp. One of the things we've talked about a lot with people is if you look at the effective rate on mortgage debt outstanding, at the end of the second quarter, it was still about 3.6%. So everyone talks about the savings rate, right, which got, pulled down. Now it's actually creeping back up again. But I've been telling people that's not the only buffer out there. We're still really benefiting as consumers from this era of low interest rates. And yes, things are starting to shift in a different direction. But I think that buffer has been underappreciated, to be honest.
An update from Alaska Rare as well, Laurie, not just United Airlines. This headline crossing in the last minute or so. Fuel prices have increased considerably in the past few weeks. They now see third quarter fuel costs per gallon of about $3.15 to $3.25. So clearly a problem for the airlines, Laurie, but maybe in your mind, not a problem for the consumer. Now, some people pointing to that positive real wage growth we might start to get going into year end and perhaps into 2024 as well. Consumer discretionary has been a big theme for a lot of people, Laurie, in certain parts of that sector. I'm thinking of the airlines. I'm thinking of the cruise lines as well. Is that kind of spending, Laurie, in your mind, set to last into year end?
So I would say let's separate the airlines somewhat from the consumers generally. If you look at airline earnings revision trends, they've actually been pretty peaky, suggesting that maybe sentiment from an earnings perspective had gotten a little bit stretched on that side. So I would maybe put those into a separate category. I did notice in our weekly, we are still tracking the TSA data, a couple of COVID high frequency indicator holdovers, and we've started to see some weakness on that. So I think that is something to keep an eye on here. But I do think generally this idea that consumers are tired of all these goods, they have too much stuff in their houses and basements, and they want to get out and live their lives again. I do think that there are still some tailwinds there. Now, is that going to slow down? We are definitely seeing, if you look through a variety of earnings calls, companies saying consumers are becoming more cost conscious. They are pushing back. They are adapting to this intense price environment around them. So I would say expect some moderation. From my seat, I wouldn't see that as reason to panic, though. I see that as evidence of rationality, to be honest.
But Laurie, just to build on that, there is a question, especially as we see Alaska Air and as we see United Air talk about higher fuel prices, how much they can pass that along to the consumer. You're saying there is price sensitivity increasingly showing itself. Is this just going to end up showing itself in margin compression?
I think that's a great point, Lisa. That's another hot topic we've been having with clients in our conversations lately is what's going to happen to margins next year. I've got a tiny bit of margin contraction baked into my earnings forecast, and that stands in contrast to the street numbers, which are anticipating a bit of expansion. One of the things we've told people is that as inflation comes down, companies are going to lose the sort of justification for passing through these price increases. And that ends up impacting revenues. The flow through to margins in my back testing, at least, is not completely clear. I think there are soft offsets like management ability to kind of manage through, cut costs in various places. So margin data is very, very messy to forecast. But I will tell you that I really see in my model evidence that as pricing comes down, as inflation comes down, it is a bigger hit to revenue growth than most people understand. And I think that's one of the new narratives people are going to have to be discussing as we start to formulate 2024 outlooks.
Laurie, I've got to squeeze this in. The headline of your piece overnight, there are tactical problems with the growth trade. What are those tactical problems?
Crowding, overvaluation, earnings dominance is eroding. It's that simple. It has been outperforming for very good reasons. We're staring down the barrel of what's probably a sluggish economy for quite some time, but that is priced in. It's just a plain old-fashioned, overvalued, crowded trade right now.
Laurie Calvasina of RBC Capital Markets. Laurie, thanks for the update from the RBC desk, the update on the equity market. We need the update on the airlines, Alaska and United Airlines, in the space of a couple of minutes. Lisa, dropping the truth on what's happening with fuel prices, and they're going up, they're getting higher.
Which is not entirely surprising given what we're seeing in the crude market. I'm just looking at the AAA diesel index right now, and you are seeing it climb some of the highest levels, certainly going back to late last year at $4.45. Here's a question, just to underscore what Laurie was saying. Do they pass it along? Or can they not do that anymore at a time where the Wall Street Journal just had a big takeout and how discount airfares are coming back in the fall because people aren't traveling enough, especially from places like Cincinnati to Birmingham? I mean, this is like some of the sort of pressures on the prices that you start to see.
That's a big question for this Federal Reserve. Do they eat it or do they pass it on? And if they can pass it on, then maybe that inflation story is not over. Maybe it's not over, and maybe this story is going to be a bit stickier than they'd like it to be.
They've been able to pass it along, and everyone has just dismissed that by saying, yeah, but everything's still strong. And you mentioned real wage growth. If that continues, then at what point do you see that strength also continue in a meaningful way?
How many times have we been told the savings are going to run out?
Exactly.
We're being told that this quarter, the savings are going to run out. The latest on this story, Anne Milletti of Allspring Global Investments in the next hour. Looking forward to that conversation a little bit later. Equity futures on the S&P 500 this morning, slightly negative. Good morning.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
we want to connect this inflation story, the thing we're watching is the oil market. The reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
What a move in crude. That was Katie Kaminsky, the Chief Research Strategist at Alpha Simplex. Your move in crude this morning, a little bit lower. We're down 0.6% on Brent crude. WTI softer by 0.5%. The prices this morning of Brent, 89.50, of WTI, 86.24. In the equity market, slightly softer, negative by 0.2% on the S&P 500. A couple of updates for you in the last 15 minutes from two airlines. One, United Airlines, the other, Alaska Air. They put some prices on fuel. Jet fuel specifically. Jet fuel prices climbing over 20% since the middle of July. That's the guidance from United Airlines. They now see third quarter all-in fuel prices of $2.95 to $3.05. Alaska Air going further on fuel costs for the third quarter, Lisa, per gallon of about $3.15 to $3.25. And the question we'll be asking all morning, can they pass that on, or have they got to eat it in the third quarter?
Especially because a lot of airlines are not hedging anymore. So they used to hedge some of these oil prices. Now, not so much. And you have to think that this is a significant part of their expenses. How much does this challenge the story that everyone's going out and traveling at a time where we're actually starting to see softness, reportedly, in airline tickets?
Year-to-date gains have been phenomenal. If we can get that board back up and have a look at where the likes of United, Delta, American have been, year-to-date, Delta's up by 27%. United's up by 28%. I know the gains were bigger earlier in the year, and those gains have faded over the last few months. But this speaks to that discretionary spending, which has held up so well through the summer. Particularly international, particularly because business travel hasn't rebounded to the same level. Does that start to shift if prices don't come down in response to maybe people actually having to go back to work? I'm just saying, did you see the articles about how airline prices are softening, particularly domestically? You know, we've talked about, do you buy that? I'm told it repeatedly and I don't feel it. Because it's not international. If you look at the international, but also it's any city that you actually want to go to, they're not. Oh, please list the cities that we don't want to go to. I'm here for it.
Sorry.
I've got a drink ready.
No, please.
Tell us the cities we don't want to go to.
I was looking at, some of these reports yesterday, and then I started to look up different destinations.
You cited Birmingham, Alabama.
Well, I think that, the game is big. Look, this Wall Street Journal story, I'm going down in flames. I think that there was a mention of Cincinnati.
Cincinnati?
Yeah.
Never been. You're telling me I shouldn't go there?
And there was also Cincinnati to Cleveland, I think, was a route that was cited as $20 fares. $20 fares.
Are you suggesting that's because people don't want to go there?
I'm just saying that less popular routes are being discounted dramatically. Let's move on.
Sure. Will Kennedy joins us now. Remember, I just did you a favour, all right? Bloomberg Senior Executive Editor for Energy and Commodities. Well, great to catch up. It's been too long. We were saying in the commercial break, it took a $90 crude barrel to get us to talk again. So, Will, let's talk now. I want to understand from your perspective, Will, when the Saudis and the Russians pull back and they say, we're going to do this until year end, but we'll review it monthly. What should I read into that, Will?
Well, I think they always like to give themselves room for manoeuvre and to maintain flexibility, but I think the expectation is that they will keep this in place into the end of the year. And clearly the oil market did react yesterday. We saw it's come off a bit today, but we saw a decent bump in the first $90 barrel since November last year. And I think the consensus is, and we've been talking to a lot of oil traders in Singapore this week, where there's a big industry get-together, is that the market already looked fairly strong, that people are optimistic about further demand growth, that yes, there are concerns about the Chinese economy, but there are also big pockets of strength in the Chinese economy and oil demand. Gasoline demand this summer has been incredibly strong as Chinese people catch up on the trips they weren't able to do during the very extended COVID lockdowns that they had. And people are pretty optimistic. So you put this on top, the Saudi pledge to keep 1 million barrels a day out of the market for the rest of the year. And to many people, it looks like a pretty bullish brew.
And, well, this is happening at a time where US oil production is near all-time highs, isn't it?
Yeah, that's right. We have seen quite a lot of supply come into the market from different places. The US is one. Iran, very notably, really strong exports. Venezuela, Brazil's added quite a lot of barrels. But I think a lot of that flow is done now, and we won't see those gains in supply from those regions that we have seen. They will taper off. So again, you set that against this extended policy action from Saudi Arabia, and it does indicate strength in the market.
This sets up some really awkward conversations this weekend at G20. When you think about President Biden, who unleashed the SPR to try to reduce prices, not really having that lever anymore, what kind of potential outcomes could come from some of the, I would guess, fraught conversations, particularly through Saudi Arabia's leader and President Biden, who I believe are supposed to meet this weekend?
Yeah, I mean, it's awkward for Washington. It complicates life for the world's central bankers, that's true. But I don't think that the Saudis will feel that many qualms. From their perspective, there has been a huge surge in inflation over the last years, and that's not really been reflected in the oil price. I mean, go back to the years after the financial crisis, and oil traded above $100 a barrel for several years, and no one got terribly excited about it. They don't see this as a terribly high oil price. And I think they would say, well, you know, we're not that sympathetic, quite frankly. The other thing I would point out about this move is that it was coordinated from the Russians, and from a political perspective, that really underscores that on oil, Riyadh and Moscow continue to work very closely together, which again, I think is a bullish sign for the market.
What is the potential offset to this? If it isn't the Strategic Petroleum Reserve, is it just a global recession? In other words, what could counter the move up that seems to have legs, at least since the middle of July?
Yeah, I mean, clearly the economic backdrop will key. And, you know, while I said that there was a general sense of optimism that Chinese demand was holding up fairly well, that is the key unknown for many people in the oil market now, that if the woes we see in the Chinese property market were to spread more broadly and put a dent in demand, and that spilled out into the world, we could see, you know, some pullback in prices. There will be a little bit of incremental supply next year from different parts of the world, but I think the expectation is the market looks quite well balanced for next year, so I don't think people expect a big fall off in prices, but there is the supply probably to meet demand. Demand won't grow as fast next year as it grew this year, as people came out finally from COVID in China. So it'll probably be balanced. So not that much downside, but not an expectation there's a huge amount of it. I don't think anyone's expecting this to go a long way above 100, for example.
A 20% move in 2 months is quite something, Will. There's clearly a supply-side story underpinning this move in crude. But then I look to iron ore. Well, it's not just oil, it's iron ore as well. What's happening there?
Again, I mean, I think people are realizing that the Chinese economy is much more nuanced than people think. And yes, clearly steel demand has taken a hit from the slowdown in the property sector, but I was having a conversation with someone at BHP yesterday, the world's biggest miner, and they pointed out that they still suspect to see a little bit of incremental demand in steel production in China this year, and that's driven by the amazing rollout we're seeing in the electricity grid, in wind power, solar power. It's being driven by shipbuilding. There are lots of industries in China that continue to go and drive demand, and for all the correct focus on the key property market, it is a more nuanced story it's emerging than people might have thought.
Too true. Well, thank you, sir. Will Kennedy of Bloomberg. We'll catch up a little bit later, I'm sure. Will Kennedy on the oil market and what we're seeing develop in iron ore as well. Iron ore near 4-month highs. And if you listen to Vale, number 2 producer of iron ore worldwide, the outlook's good. Compare that to some of the doom and gloom around the China story, and you've got a number 2 producer of iron ore on the planet saying the outlook looks pretty good. It's encouraging, to use their word.
It is an incredibly confusing moment. That's all I can say, because on one hand, you do have industrial investment in the U.S. and even in Europe. So at that level, you are seeing potential increased spending there that could overcompensate for something going on in China. But it is confusing. I do want to just bring you this correction.
Sure.
It's an important one. I was looking back at that story about the routes that actually were $20, and it was Cleveland to Orlando and Detroit to Atlanta. It was not Cleveland to Cincinnati. There also were some from Mexico to Central America for $115. That's what I was looking at.
Okay. You just don't like Cincinnati.
No. My father was born there. It's not like I have anything against it.
It's just a name of a city that popped into your head that you might not want to go to.
No, I wasn't making any comments.
Alan
I was just saying.
Deutsche Bank.
Thank you.
It's coming up a little bit later on the FX market. The dollar stronger for 8 consecutive weeks, and the pushback from Japan, from China. That story up next. Equities a little bit softer. Soft start to the week, to be honest with you. We're down here on the S&P 500 by 0.2%. On the Nasdaq 100, we're negative by 0.3. Negative across the board. The Russell struggling a little bit again. We're down by 0.1% there. In the bond market, yields climbing 16 basis points in just 2 sessions on a 10-year. Down about a basis point today to 424.60. But a curious move, I've got to say, in the bond market, Lisa, off the back of jobs data that some people might say would lead to lower yields. Not higher yields. We got high yields on Friday and high yields on Tuesday.
It was called Goldilocks. It was called the perfect report for the Fed. And you saw yields grind higher. And then yesterday, people are now blaming supply, $36 billion of investment grade
There's
bond
lots
supply.
of it, granted.
Lots of it. So people are selling their treasuries in order to raise the capital to buy the oncoming debt issuance. Still, there's something else going on, and it's driven by real yields. And that's important to know.
Yeah, that something might be in the commodity market,
yes,
maybe.
Exactly.
The rally we've seen in crude reclaiming 90 briefly for the first time since November of last year. I want to turn to the FX market. Let's take a look at foreign exchange. The euro, negative over the last several weeks. The euro right now slightly positive by 0.1%, clinging to 107.37 on that currency pair. Just the data out of Europe, just dreadful. I've said that so many times over the last few months. And again, German factory orders just not pretty at all, Lisa.
Stagflation. And I think especially when we start to talk about the potential for higher diesel costs, higher gas costs, just higher in general food costs, we're also talking about higher rice and sugar prices. At what point does that really challenge the ECB's ability next week to come out with something truly hawkish versus just hawkish light or hawkish talk?
Personally, I wish that was a bigger part of the conversation at the ECB news conference, given that in the accounts from their last meeting, they basically acknowledged that might be the situation they're in. At least they're considering having the conversation. Then it was totally absent from the news conference. So September 14th, hopefully in the presser, this is something they have a conversation about. Why is that something they think we can escape?
Well, I don't really have conviction that they're going to say anything. Have you heard Christine Lagarde's comments? I know you have. They're the most non-committal comments I could ever imagine. Basically, we don't know what's going to happen. We're going to do what we do, watch and see. And that seems to be the tone. Can they afford to do that when the data is coming in so weak? Can they afford to take that sort of non-committal stance when you do see signs of stagflation that are just mounting over in the euro region?
Single issue mandate, does that complicate things?
Do they have a single mandate?
Well, that was a question we raised yesterday on this programme. Do they? Is it a dual mandate that they don't actually have that they're following right now? Is there an unwillingness to crush the economy to get inflation back to target? Yes, inflation is the number one job, the only job, apparently, but this stuff is always open to interpretation. How Trichet viewed their mandate was very, very different to how Draghi viewed it.
Well, and we heard that from guests yesterday, that basically the market is implying in the pricing that there is a dual mandate for the ECB, not just for the Federal Reserve, because they are not going to curtail momentum to such a degree in order to get inflation back down sooner. Although Klaus Knott did say, and I thought this was interesting, the importance of getting inflation down to 2% quickly. And that was something new.
We'll come back to those comments in just a moment. Under surveillance this morning, it's all about dollar strength, prompting authorities in Japan and China to step up their defense of their currencies. Japan issuing its strongest warning in weeks. China's central bank offering the most forceful guidance on record with its daily reference rate for the yuan. There is a problem for dollar yen as it gets closer to 150 or 147.35, and for the Chinese currency at 730 against the US dollar. Numbers we haven't really talked about, Lisa, going all the way back to 07 for the Chinese currency.
They're two very different stories, but really struggling with the same thing, which is weaker data over in Asia is going to get punished in the currency market probably more than anywhere else. And we're seeing that consistently. In China, the question really is, at what point is this beneficial in terms of exports versus not in terms of buying power, in terms of inflation? For the Bank of Japan, it seems unsustainable to keep yield curve control. But at the same time, they are seeing softening economic data. So where do they place the priority right now at a time where they're trying to thread a needle? And they've actually done it pretty successfully so far. I don't know. Again, there's not a lot of conviction in markets they're actually going to follow through.
Equities a bit of a snooze at the moment. I think I can say that. Stocks just a little bit of a snooze over the last couple of days. The entertainment, the drama maybe. In the FX market, the bond market, and perhaps in here too. Crude, testing the highest mark since November after OPEC Plus leadership announced they would extend supply cuts through the end of the year with a monthly review, for whatever that's worth. Brent crude retreating just a little bit this morning, just south of 90 on Brent to 89.62. But this after delivering double-digit gains over the past 2 months. That's a 20% move on WTI in 2 months. On Brent, That's a 17% move.
And we were just talking about the airlines coming out and saying that they are facing some serious increases in diesel costs. Well, diesel prices have climbed more than 40% in the U.S. and Europe since May, just to give you a sense of how much that's been an increase, which raises a question, why now is Saudi Arabia doubling down on production cuts? I think it's 1 million barrels per day that they're cutting production, being bolstered by Russia. Is it just because they can? Is it because they want prices to be $100 a barrel? There is a question. What is the target that they have?
The strategic midterm reserve is not available to drain this time around.
Yes, exactly.
They're meant to be rebuilding that, aren't they?
That's a big issue.
That's a complicated effort now.
Because they can't. They said that, they were going to rebuild it at $70 a barrel? Well, we got to $70 a barrel.
That was a few months ago.
And they did not rebuild. So here we are. And there's a question, especially heading into the election. Forget midterms. The election. How do you handle this? And what are those conversations going to be like over in New Delhi?
I'd go a couple of steps further on this crude move. It's happening at a time where everyone is really, really downbeat on China. Pretty much everyone on this programme, with the exception of maybe Jay Poloski over at TPW. And it's also happening at a time where crude output in this country, in the United States, is getting close to record highs again. So crude output close to record highs in America, doom and gloom over in China, and we're back to 90 on Brent. That's quite something, given all of that.
I don't understand the oil market. I didn't understand why it went down as much as it did earlier. People were saying it's partly because of the financialization of the market. I don't understand exactly what Saudi Arabia is doing and why it's reflected in this market. But I think, to your point, the fact that it's not just oil, that it's also in other commodities, tells us that this is more than just supply and demand.
Some warnings from United Airlines and Alaska Air in the last 30 minutes, as Lisa indicated. Lisa also pointed out this story, so let's finish there. Investors betting against an ECB rate hike next week are, quote, maybe underestimating the chances of it happening, according to Governing Council member Klaas Knot. Knot calling a further hike, quote, a possibility, but not a certainty, and adding, I continue to think that hitting our inflation target of 2% at the end of 25 is the bare minimum that we have to deliver. That meeting taking place on September 14th, a week tomorrow. Alan Ruskin joins us now, Chief International Strategist over at Deutsche Bank. Alan, talk is cheap. Japan is talking a lot. Will verbal intervention work?
I think you hit the nail on the head. Talk is cheap. They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. They've effectively freed up the 10-year yield to move above what is now their latest cap at 65 basis points. So they can let the 10-year yield drift up. The equilibrium rate's probably somewhere between 1% and 1.25%. If we did see a 50 basis point increase in the 10-year yield, that would do it, I think. That would do a lot more than intervention is going to do as far as capping dollar yen.
Right now, we are seeing that 10-year treasury, the 10-year Japanese bond at 65 basis points, which is sort of shocking given where it's coming from, just in terms of how much it's crept up. Alan, what is the line in the sand for the Bank of Japan? It seems to be moving in terms of the yen, and at what point it is too weak?
Yeah, I think it's fortunate that it's moving because lines in the sand are open to market attack. We've consistently seen verbal intervention in this sort of 145 to 150 range. You would think that if the yen is being singled out for weakness and we move above 150, then on those two conditions, really, some intervention could well be seen. But I think it's going to need to see something a little bit different from what we're seeing right now, which is the yen being singled out for weakness. In general, we're seeing a lot of other currencies under the cosh. China, same sort of story in some sense. So I don't think the Japanese can say there's a Japan story in particular.
Although in Japan, it's not a positive thing. They don't want to see a currency that's this weak. Over in China, there's a question of maybe they want a weaker currency. Maybe that will actually help juice growth by increasing exports. At what point is a weaker yuan a positive for China versus something they want to intervene with?
Well, I think it is a positive. The authorities might, look at it somewhat differently. There are all sorts of things like national pride that get roped into views on the exchange rate. But I think if you looked at the pure economics, you'd say, look, China's facing deflation in its asset markets. It's facing disinflation in its goods market. The exchange rate is a very natural safety valve to allow for policy easing that you can't enact anywhere else. You've got interest rates extremely low at the moment. You've got liquidity on the soft side. So the exchange rate's a natural vehicle, I think, to actually ease up.
Alan, if there are benefits from that, why are they setting such an aggressive reference rate? What do you think that's about? Concerns about the pace of the move?
Yeah, I think at the moment, it does seem like the authorities care an awful lot about their levels and, the level vis-a-vis the dollar in particular. I think there are elements there, as I said, where, the weakness that you're seeing, I think they don't really want the exchange rate to be another source of instability. And it is obviously something which the markets can really latch onto. It's very visible in a way in which the property sector problems are much less visible. So I think they, in some ways, trying to control the things that they think they can control for the time being, probably paying for time to some extent, because, if the Fed does eventually cut rates in 2024, you do have the basis then for a somewhat weaker dollar, and it takes some of the pressure off the Chinese authorities.
Do you think that the dollar has appreciated so much, though, Alan, that it is presenting some sort of stability risk more generally? At what point, how much further does it have to go to actually shake things up just because of some of these pressures over in Asia in particular?
No, I don't think it's a stability risk. Honestly, I think disinflation and deflation are the stability risk. I think the Chinese authorities have the capacity to manage some weakness to the extent that the external accounts are still pretty strong. Exports are pretty much doing what the rest of Asia is doing, but they could be stronger. But the current account is in solid surplus, and I think that's going to cushion any particular weakness. I don't think they need to be too afraid that all of a sudden the yuan is going to drop precipitously.
Alan, thank you, sir. On foreign exchange, Alan Ruskin at Deutsche Bank. We need to talk about this right now, just to jump in and get you some more news from the airlines. 3 names to look at in the pre-market: Southwest, Alaska, United. Updates from all 3 in the last 40 minutes or so. Southwest getting hammered, down by close to 6% in the pre-market. An update from them: they had seen third quarter fuel costs at $2.55 to $2.65. They now see third quarter fuel costs at $2.70 to $2.80 per gallon. This after Alaska Air had to come out and basically do the same thing, now seeing fuel costs per gallon of about $3.15 to $3.25. United first out the gate about 40 minutes ago, saying jet fuel prices climbed over 20% since the middle of July. That new range for fuel prices in the current quarter, $2.95 to $3.05. The question we're asking: have they got to eat this, or can they pass it on? Southwest with this headline: they continue to expect solid profits in the third quarter and the full year, Lisa, for 2023.
And United Airlines, in a similar vein, said that they're going to reiterate their guidance. So they're not lowering their guidance for profits, even on the heels of an increase in fuel prices, which really raises some questions around how much they can pass along versus cut costs in other areas, how much this really points to that stickiness that we keep talking about, especially with increase in real incomes.
I imagine, based on what we've seen in the last 40 minutes, we'll get an update from American and Delta, no?
I guess
in the next couple of minutes.
I was actually just looking as to why we're getting all of these now. What's sort of the impetus and the occasion for everyone to be updating on oil prices, other than oil prices are up, so it's a nice convenient excuse to put out there ahead of earnings season? Nonetheless, yes, we will get others, I'm sure.
Highs for the year, and we've said this repeatedly already this morning. Highs for the year, even with what's developing in China. And it's not just crude that's rallying, it's iron ore as well. So just how bad are things in the Chinese economy at the moment? Leland Miller's going to join us next, co-founder and CEO of the China Beige Book. If you're struggling to get clarity on what's happening in that economy right now, this is the man that might give you some visibility. Live from New York City this morning, good morning.
So what we've seen in recent months is a substantial slowing in the economic conditions in China. And because our economy is closely intertwined with the Chinese economy, we are not and will not be immune from a slowdown in China.
Just to state the obvious there, the Treasurer of Australia facing some headwinds from that slowdown in China. From New York City this morning, good morning. Your equity market looks like this Wednesday morning. Equity futures just a little bit softer, negative by 0.2%. Yields a little bit lower by a couple of basis points. Your 10-year 4.2420 after a big move over the last couple of 2 days. On a 10-year yield over the last 2 days, a 16 basis point move Friday and Tuesday. Remember, we took a day off Monday, although it doesn't feel like it, Bramo. That rant, I'll save that for later. 4.2420 on a 10-year in the FX market, a euro 107.39. Just about showing some strength here on the euro side of things. Positive by 0.16% on that currency pair. Some strength in the face of some weak data over in Europe, Germany specifically. At the same time, a hawk on the ECB, umming and ahhing about the possibility of hiking, Lisa, a week tomorrow.
Umming and ahhing is probably the best way to put it, because he didn't really commit to anything but wanted to juice up the expectation that you could get a rate hike. It just is unclear where we are in the monetary policy. And I do think that the Bank of Canada coming out in about 3 hours is going to be interesting. If they hold the new hike, and does that give people confidence in some sort of growth?
We're cutting elsewhere. You see the moves in EM?
Yeah, it's insane.
They're cutting there.
Yeah, but
they're the original front loaders.
Sure.
They are the original front loaders.
But cutting from what, 13% to 9%?
Yeah, like double digits.
So, I mean,
like
at a certain point, are we talking
beast.
really apples to apples?
We're not at all. It's a different beast. It's just EM versus DM.
Yeah.
It's certainly not and never will be apples to apples. Leland Miller joining us now, co-founder and CEO of China Beige Book. Leland, great to catch up with you, sir. We're all trying to work out what's happening in the Chinese economy. Everyone's saying it's bad, and then we look at iron ore, 4-month high. We look at crude, new highs for the year. Leland, how bad is it?
Well, the discussion in Q2 used to be about, are we going to see a big recovery? Are we going to see a mild recovery? Are we going to see a tiny recovery? The discussion has moved dramatically to, is China collapsing? And so it's pretty easy to discount that out of hand. We're getting new data in. China's not collapsing. Property's a mess. But most of the rest of the economy is chugging along. Things are not going great, but people like to focus in on one area of the economy, which has particular woes, which is property. And you see the shadow banks wobbling. And so you see problems across the economy right now. But, manufacturing is holding up better than we thought. Consumption is still disappointing, but you've got areas of services that are still doing pretty well. In our revenge spending basket, not doing too bad. So look, this is not an economy that's doing particularly well, but you have to contrast that with market perceptions of how the economy is doing. And there's really no comparison that China is doing far better than what people think.
To your point, Leland, the focus is always on where the drama is, the mess. What's the relationship between the mess, the property market, and consumption more broadly in China? Not just right now, but historically speaking.
Well, look, if we take the big picture on this, it is intertwined, because historically 70% or so of Chinese households have had their savings invested in property. So if you see property prices going down, you see, chaos across property, people worried, then they're going to spend less. Maybe they're saving more. So some of this is intertwined. But you have a bigger problem, which is confidence in the economy. And I think that's why the consumption sectors haven't jumped the way a lot of people expected them to this year. But the property thing is still a very different dynamic, because it is happening because Beijing is allowing it to happen. For 3 years, we've been talking about the fact that Beijing wants to diminish the role of property as a growth driver in the economy. They're doing that. Everyone said they should do that. But now that they're doing that, the market's saying, oh, no, wait a second. This is scary. Give us stimulus. That's not the way it works. So this is a tough process.
Leland, you said that China is doing far better than people think. Is that in the short term, or is that in the long term, or both?
Great question, because yes, I am talking about cyclically. Structurally, we are in for a long-term slowdown. I mean, this probably sounds like I have a bumper sticker on it, because we do. We've been saying this for years and years when, rates were up our growth rates were up at, 8%, 7%, 6%. Say, look, the economy is structurally undergoing a slowdown that is going to take it into the very low single digits. That is not changing. What we are seeing right now, though, is coming off COVID zero. There's a bit of a cyclical bounce back. Things are not great in 2023. They're better than they were in 2022. So look, that as long as you don't have long-term expectations that things are going to get materially better and jump back up to the old rates of growth, or revert to the old stimulus playbook, then you can sort of manage this in a relatively sensible way.
But if markets are a discounting mechanism and trying to look forward at something that is subpar growth, at least relative to recent history, and if you're looking at a lot of policy ambiguity as far as where the government's going to step in and push different weights to balance or unbalance different industries, why would you have any conviction to invest in an area, especially at a time where we hear so much about decoupling or people and countries moving away from China?
Well, part of what we've done over the past decade is tell companies, look, be very, very clear on what you want to accomplish in China. If you think you're going there because it's the growth engine of the world, then you've got a very bad China strategy. If you're going there because you want to build up China operations to be able to cater to Chinese consumers, and you're taking care of supply chains that they're not getting intermixed and they're not going to fall victim to geopolitics or to politics, then that's a different story. There is a China growth story. It's just not the one that people have been running on for the past 10 years. So you have to be very careful about, if you're in China as a corporate, why are you in China? What are your goals? Because 5 years ago, people had big goals and they're just not achievable anymore.
In China, for China is a phrase we've heard tons of from various guests, Leland, over the last year or so. Leland, I want to talk about what's happening domestically in China and the breakthrough that we saw from Huawei over the past week. Leland, how key is that for Chinese ambitions? It's
tricky. So the Huawei breakthrough is the idea that China can produce advanced chips. There have been U.S. export controls. Are they evading these export controls? Are they beating the export controls? Look, I think that what they have done is created an advanced chip that looks like it's scalable in some fashion. That in alone is a sort of big deal, but the yields on this are reportedly not that high. They're just throwing money at this in order to develop their chip ecosystem. So the lesson is not that export controls are failing. The lesson is probably that export controls have too many Swiss cheese holes in them and need to be bolted up, but also that the Chinese can brute force some of this, but not most of it. And it's a very difficult long-term strategy if their strategy is to brute force all this.
There's so much chatter about that over the weekend, including this story that Xi Jinping won't attend the G20. Leland, what should we read into that? The importance of that, not from our perspective, but from their perspective, from the Chinese Communist Party's perspective?
Well, look, there's all kinds of rumors that, Xi's getting a lot of feedback at home that he needs to shape up. Look, those things are impossible to verify. The lesson here should really be that we can't put ourselves in Xi's head because Xi makes different decisions than most people in markets would do if they were in charge of China. For the last couple of years, all we've heard is Xi Jinping would never do this because he'd never kill the golden goose. He'd never do that because he wouldn't kill the golden goose. If COVID zero didn't break that mindset, I don't know what will. I think we have to be very humble in trying to guess the intentions of Xi Jinping. What he signals is that he is going to be, focused on slower growth in the economy. He's going to be focused on, building up China from a national security perspective, trying to insulate it as much as possible from U.S. leverage. I think we can we can invest in those ideas, but I think trying to guess what he thinks from day to day is very, very difficult.
Leland, well said. It's great to get your take. Thank you, sir. Leland Miller there of the China Beige. Lisa, to his point, people who have played that game, tried to get into the business of being in Xi Jinping's head, have found themselves on the wrong side of the story many, many times over the last couple of years.
You can get every kind of narrative that you want around what he's thinking or what he's trying to do. And every single time you're probably going to run up short in terms of different actions that are unexplainable. This is one example we saw yesterday, talking about banning iPhones for certain government officials in certain government practices. This question of, well, they don't want to kill the golden goose, and yet they do have an integral relationship with Apple. Are they willing to sacrifice it in part to really put forward their own industry? These are some of the questions that a lot of people say they would never do that, and yet. And that's some of what's coming to the fore.
Are we surprised by that, given that some government agencies aren't allowed TikTok and all of that stuff? We see that all the time, don't we?
I'm not surprised by that, but I am surprised, given some of the rhetoric that we hear, that they both need each other, that Apple and China work symbiotically. If that's the case, why do you want to, give a slap across the face?
Would you say that Apple needs China more than China needs Apple?
I think it's difficult. I would defer to somebody else. There are a million people who are employed by Apple. Yes, of course, as a company, maybe, but I would have to look at the numbers.
All right.
I'm very diplomatic.
Very diplomatic.
Very diplomatic.
Just wanted your gut instinct on that story, Ramo. And Maletti of Allspring Global Investments is coming up. Your equity market on the S&P, slightly softer here. We're down by 0.2%. From New York, this is Bloomberg.
I think the rally does have legs.
There is a slowdown that's underway, that there's no question, but I don't think people are positioned for it.
I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down.
There's a little bit of a fear in this higher for longer type environment that yields go even higher.
The risk is that the Fed is prematurely declaring victory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market on the S&P negative here by 0.2% on the S&P 500. At the epicenter of the conversation this morning, $90 crude. And the airlines have a bit of an issue here. Lisa, in the past 60 minutes or so, we've heard from United, we've heard from Alaska, we've heard from Southwest.
And all of the comments are the same, which is oil prices are going up and it's causing a significant increase in their costs, which is concerning considering it's one of their biggest costs, and it's unclear how much they can pass along to consumers. And that is what is underpinning this. How sticky can this be in inflation?
Southwest down by 4.5% in the pre-market. They had a line on that, Lisa. They said they continue to expect solid profits in the third quarter and for the full year 2023.
I'm trying to square this with this idea that you're seeing more pushback, the idea of discounted fares increasingly written about, if not seen by anybody who I know. But there is a question going forward about whether there's going to be real margin compression, not just with the airlines, that might be the most obvious candidate, but margin compression as a result of higher commodity prices, which are happening despite some of the warnings that we hear with weakness in other parts of the world.
Plenty of Fed officials that we've heard from, including Patrick Harker, who we spoke to from the Philadelphia Fed over in Jackson Hole a couple of weeks ago, want to put rate hikes on ice. And then you've got this move in crude, and you wonder if that complicates things again, looking ahead to CPI a week from today.
You asked the right question. Is this because of demand? People are just going everywhere and so excited and growth is so robust that you're seeing that increase in prices? Or is it supply? Is it because of the supply cuts that you're seeing out of Saudi Arabia and out of Russia? If it's the supply side, maybe the Fed doesn't have to do anything because maybe this isn't about growth at all. This is just simply actually disinflationary because it will take money out of people's ability to spend. If this is driven by ongoing demand and the ability to pass along price increases, that is a different story for the Federal Reserve.
Very different stories. Now, I want to be really specific here. The Federal Reserve officials there talking about putting rate hikes on ice. The ECB this morning, anything but. Two officials, two speakers in the last couple of hours. Klaas Knot of the Netherlands spoke to us a little bit earlier this morning here at Bloomberg, and he said this. He thinks the markets may underestimate the chances of a hike a week tomorrow from the ECB. And seconds ago, we hear from another ECB official, Lisa, saying September, that hike would be preferable to hiking later on. So the hawks are going into this meeting, I wouldn't say screaming, beating the drum, banging, going loudly into it and saying, let's hike, but certainly opening the door to that and introducing some two-way risk into that meeting.
And you have seen the probabilities implied in markets creep up. I think it's about a 35% chance now that there's going to be a rate hike next week at the ECB meeting. This raises a question of what they're trying to do. Are they actually considering a rate hike, or is this trying to jawbone a market into being more restrictive so they have to do less? And these are two different things, and we've been playing this game for a while. Are they in a different spot? I think you made a great point earlier. Do they have to address stagflation directly? If they don't, do they have credibility?
Well, let's get someone in that news conference to make them.
Bake them?
Yeah,
Are you
just
planning
make them,
to take a trip over there?
In the presser. I'm not going. I get invited still.
Let me tell
I still get the invites.
Why don't you ever? You should show
I still
up.
get the invites.
Jonathan Ferro from Bloomberg
That's such a
Surveillance.
TK move.
It would be so good.
I'm going to Frankfurt
It would
next
be
week just to
great.
sit in the press conference and try and get a question. Absolutely not. Let me
I
look at the
support
FX market just briefly. The euro showing a bit of strength off the back of these headlines, just a bit. We're positive here by 0.2% on that currency pair, 107.45, even with some terrible data out of Germany, factory orders. Incredibly volatile, I know, covering that month to month, but still deeply negative. In the bond market, yields a little bit lower by a couple of basis points on a 10-year 424.20. And equity futures a bit softer here, Lisa. On the S&P 500, we're down by 0.25%.
The ECB hawks are really pushing against a groundswell in central banks of developed markets around the world, which is let's hold, let's wait, let's see. Bank of Canada is likely to be the next one to do that. 10 a.m. coming out with their rate decision. The expectation is for them to hold at 5% because growth is weakening. You are seeing around the edges, even though inflation is high, some measures of economic prosperity are starting to diminish. At 2 p.m., we get the Fed's beige book. Anecdotal evidence. How important is it at a time where you do see the Atlanta Fed GDP forecast come in at near 6%? Is Patrick Harker of the Philadelphia Fed really leading the charge when he says anecdotes might matter more than some of the other hard data indicators? And today, central banks speak. There's lots of it. Bank of England's Andrew Bailey speaking at 9:15 a.m. Boston Fed President Susan Collins and Dallas Fed President Lori Logan speaking later. To me, how much do they want to push on this hawkish tone, if not substance? Does it matter? Does this lead to some sort of move in markets, or are people just basically saying, show me, don't tell me, because I know what you're doing?
I might actually read the beige book later.
I think I will too. I usually do, actually. Tom will not.
No, Tom never does,
No.
but I might actually. I know you do every time it comes out, but I might actually read it this time.
I hope that you're starting to appreciate that it actually is interesting and important. Because you
What, the
always
beige
say,
book?
yes, you always say to me, you're trying so hard to make it interesting, and it's not at all. But it is.
Patrick Harker
It's-
made it interesting at the Philadelphia Fed.
did.
Dallas Fed Manufacturing recently, some of the feedback they had from various industries, that makes it interesting too. I'd be surprised if it was strong, based on what we've heard from a couple of Fed officials.
And based on what I've heard from certain friends who are small business owners who say it's going to get a lot harder. They don't have the same leeway without that ability to lever up.
Got to talk more about these friends and these businesses. Try and get a lead on what's in the beige book. Do they contribute to the beige book?
Moving on. No, they don't. But it's sort of, the restaurant industry and some of the smaller businesses in New York City. And what happens if there is a fall off in certain areas or a removal of certain outdoor spaces? How do you compensate and still pay the higher overhead? Very big concerns.
These aren't friends in Cincinnati, based on what you said.
Honestly, I thought you said you were going to give me a pass.
Anne
Is this where
Milletti
it comes
joins us
back to
now,
hurt?
Head of Equity at Allspring Global Investments. And great to catch up with you. Lisa and I were talking about what's happening with some of the airlines this morning, talking about higher fuel costs, moves of something like 20% since the middle of July. And Lisa and I asking the right question, I think, is whether they have to eat it or they can pass it on. And do you think the consumer tolerance is still there to pass on higher prices?
I think it's going to be a little tough, Jonathan. I mean, the consumer really has taken on a lot this year, and, they've gotten a little bit of relief. But honestly, there's a lot of consumers that think they really just haven't seen as much relief as they need. And so remember, travel is something you can cut back on. And I think we will tend to see that. Also, remember, we have seen corporate travel start to come back. And corporations do have a limit too with budgets. And if airline prices get too high, you might start to see some corporations pull back on their travel spend as well.
There's a larger question, Anne, about just higher oil prices and what that does more broadly to equities. Is it supportive in the sense that it does drive up the prices of energy equities in particular, or is it depressive because you are going to see more margin compression, more pressure around the edges when people are getting aware of prices?
You hit the nail on the head. I mean, it's a double-edged sword. For the energy stocks in particular, it's a positive in the near term. And, look, it's been a tight market, a tight supplied market. That's been good for most of the energy companies this year. Also, we've seen a lot more discipline. This is something that we've talked about before in the U.S. producers. And so that's been good. However, the higher the energy price goes, the more difficult that is on company margins. And it is an input to so many companies. So that will continue to be a challenge. I mean, one of the questions we were asking yesterday is, does energy drive the economy, or does the economy drive energy? It's like, what comes first, the chicken or the egg? And we know it has a big input into the economy. But because there's fewer suppliers really in the market today, and you and Jonathan were talking about this, just a much tighter supply market, the price is much tighter controlled. I think the only good thing about this is the Saudis really do not want to see prices go above 100 or stay above 100 too long. They know that does damage demand, and they don't want to do that either. So I do think there is this fine balancing act that they're trying to create. Whether or not they're successful, that'll be interesting to see.
So if you put this to the side, if you say that this is a controlled move in response to a very specific price bogey that Saudi Arabia has, what are we looking at in terms of understanding the market action over the past couple of sessions? We've seen yields up, even on some Goldilocks type of information. And we are seeing the real gains still coming from the big tech drivers, which used to be supposedly interest rate sensitive, but now suddenly aren't. Is that going to be just basically the de facto go to those, even if everything else isn't working?
It's a great question. I think it's been a little head scratching for some investors. When you really study it, I think when you take a look at what's happened so far this year, it's been frustrating, I think, for some of our investment teams as well. But earnings growth really has come from some of those big concentrated, tech names in the large cap space. When you look at where earnings growth is going to come from, though, it does start to diversify a lot more, and it goes down cap. And, we've been talking, I know on your show, I've mentioned small and mid cap, and that is a space we thought the market would diversify. That did start to happen in late June and July, pulled back a little bit in August, but we do think that will continue to happen. Also, as you look across sectors, I do think other sectors will be more attractive when you look at, again, where earnings rebounds will happen. And there is reason to be concerned that you will see a little bit more earnings pressure on some of those large cap tech names.
Small caps got hammered yesterday, down by 2.1%. And thanks for the view, Anne Meletti there of Allspring with their view from their desk. Lisa, from my desk right now, looking at the Russell, that was tough. That was tough for the small caps yesterday.
Did you see the home builders?
They had a tough time of it too, yeah.
Slammed, and a lot of people saying that was because of the rise in real rates. But we've been seeing that all year. I don't really understand. It was the worst day for them since October 2022.
Great line from Richard Bernstein, who I'm going to catch up with a little bit later. This quote here: "The performance of the Magnificent Seven versus the Russell continues to stretch. We should all hope this doesn't continue because the implications for the US economy dire. We're simply not that bearish." My first question to him today, is that hope or a strategy? Is that hope or a strategy to expect that to close anytime soon?
That's a good question, especially as people say that AI is going to control everything and it's going to cook your meals and clean your home and drive you to practice. I mean,
there's a great career hedge, isn't it? Just allocate some capital to AI.
Well, and that's the reason why people keep going into it, even as you have Rob Arnott coming out yesterday and saying that it's a big bubble and NVIDIA is leading the charge. So at what point do you have some sort of reckoning, especially if the earnings, as we just heard from Anne Meletti, are delivering, even as you're seeing some motley performance in other areas?
That's what I loved about things earlier this year. Certain investors that said, yeah, it's a big bubble, I'm going to have some. I'm going to have some of that.
Ride the bubble.
Totally.
I'm all in on the FOMO trade.
Massive gains.
Yeah, and they won. This is the question, though, going forward, can it continue? I thought it was interesting, though. Real yields going up. That used to be a killer for tech. Suddenly, they're the haven. They actually outperform better than everybody. And you have rate-sensitive areas absolutely getting slammed.
If you are just tuning in, welcome to the program. Equity futures here negative by 0.2%. Coming up in about 45 minutes from now, we'll catch up with David Leibovitz of JP Morgan Asset Management. A wonderful quote from Jim Bianco of Bianco Research, who we spoke to yesterday. He said the contrarian players short bonds on no recession, sticky inflation, no cuts in 2024. And in his view, that move in crude contributing to that story.
How contrarian is that now? We're hearing that from more and more people.
Data Bianco. They like to be contrarian.
Katie Kaminsky, and
on that page.
it was contrarian maybe a couple months ago. Increasingly, it's not, which is the reason why you haven't seen yields come in dramatically on the long end, even though people are still talking about going back to some sort of low-rate reality.
What is consensus? I'm so pleased you asked. This from Jeff Rosenberg of BlackRock to TK on Friday. A gradual decline in inflation, leaving the Fed to have to cut rates, not because it is a hard landing or because they're overly tight, but because it is avoiding becoming overly tight to maintain restrictiveness. That's consensus, apparently, in the bond market. Hey, Rosenberg, yeah, something like that.
A lot of people are looking for that. But
they say those things, but then they don't like to use the G word.
We'll use it.
Don't like to say it. From New York, good morning.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
I'm glad to welcome our colleagues back. Now, one particular moment of my time back home has received its fair share of attention in the press over the past week. But I assure you, August was a busy and productive month for me and my staff. Every Kentuckian I met voiced the same message. There's too much government and too little being done to boost the economy.
That was Senate Minority Leader Mitch McConnell returning to the Senate after the summer break, freezing for a moment for the first time in a couple of months, a delicate moment. That note there, I met many Kentuckians who said the same thing. There's too much government, too little being done to boost the economy. At least I have to say, according to most polls, there's too many politicians who are too old down in Washington, D.C. on both sides of the aisle that just won't retire.
And we're going to hear more about that from Mitch McConnell himself today. Probably there's a meeting of Senate Republican leaders, Senate Republican members who are going to come together and maybe ask him about that and give him a chance to respond. What's he going to say? Is it up to him to decide whether or not he steps down ultimately? Or is this something that Senate Republicans can really push?
AMH joins us now. Anne-Marie down in Washington, D.C., our chief Washington correspondent. AMH, let's speak to that. Did he really address the concerns about his health over the last few weeks?
Well, listen, it was an 8-minute floor speech, and he talked about that, quote, particular moment that happened most recently. That happened in August. That was the 30-second freeze, but there was the 20-second freeze as well in July. Very sad, uncomfortable that this was all played out in public for the Senate Minority Leader Mitch McConnell. What we did hear is from the congressional physician who said this has nothing to do with a stroke or this has nothing to do with seizures. Remember, Mitch McConnell fell earlier in the year, suffered a concussion. Potentially that is just him still recovering from that. But it is an elephant in the room that will be discussed likely today, as Lisa mentioned, when Senate Republican members meet. And what we heard from Senator Thune, who is a top contender, part of the leadership structure in the Senate on the Republican side, Senator John Cornyn, another top contender, part of the leadership structure, and he's from Texas, is that this is something Mitch McConnell does want to address and be a bit more transparent about. So maybe behind closed doors with his colleagues, he will be a little bit more transparent about what is going on with his health. We only got really a snippet, I would say, into that window.
Don't believe your lying guys. I think many people find this incredibly frustrating, Anne-Marie. Who are these doctors that say these presidents have clean bills of health when we can all see that there is something wrong here? And it's not just Republicans, it's Democrats as well. Dianne Feinstein, a senator we talk about a lot. Who are these doctors giving these clean bills of health when we can all see something's not right?
Well, this is the congressional physician, Brian Moynihan. I don't personally know him, but he released this statement yesterday via McConnell's office as well. And I do think Senator McConnell's team wants to be as transparent as they can. So not even sure they would have had to have released that doctor's note, but they did. But, Jonathan, the point you're bringing up is that obviously anyone who is witnessing these moments, whether it's Dianne Feinstein, senator from California, being told to vote yay. She was obviously very confused where she was in that moment after coming back with a bout of shingles. And then Senator McConnell freezing up twice this summer. The public sees this and they want more answers. And there's also a lot of polling to the upside of individuals and voters who want to see term limits enacted or age limits or mental acuity tests, because there is a concern that America, we're just living in more of a geriocracy than a democracy.
And Marie, there's a real concern here on a policy front, too, in terms of timing. If Mitch McConnell's leadership is questioned in any way, what does that mean for the negotiations having to do with the budget and government shutdowns potentially later this month?
Well, he addressed that yesterday, and there's one key moment before he froze up last month in Kentucky, is right before that episode happened. He said it's going to be a real big mess. So they have a federal spending issue because the government runs out of money September 30th. They need to either vote on a continuing resolution, because it doesn't look like they're going to get all the 12 appropriation bills from House and Senate and then go into a conference done in time. There's just a number of legislative days they have left. On top of that, there's another issue, but potentially it'll be linked together in one bill, is this supplemental funding. And Mitch McConnell spoke about that yesterday, because obviously when you see a divide among some Republican voices about aid to Ukraine, what the White House is asking for in this supplemental funding package is more than $40 billion. Some of that will go to aid to Ukraine, which Mitch McConnell says we need to vote on for national security purposes, but also money for disaster relief, what we saw just take place in Florida, in Maui. So this is going to be a showdown, not just between Republicans and Democrats, but between the House and the Senate. And Mitch McConnell has always been one of those individuals who can really maneuver the Senate and make sure bills that he deems worthy do get passed and over the finish line.
That's where I was going with this. Without his leadership, who takes that role? Does anyone take that role? What does that mean in terms of the likelihood of a government shutdown?
Well, listen, there's potential there's going to be a government shutdown, whether or not Mitch McConnell is going to be the leader. But this vacuum potentially, he does have a succession plan, although it doesn't really talk about out in the open, but there's three Johns everyone talks about, Cornyn, Thune, Barroso, that could potentially fill this role. But right now, we should note, no one is publicly, besides maybe a few like Josh Hawley, who voted against him in the past, no one is publicly coming out and saying Mitch McConnell cannot do this job. Actually, the opposite. What you see is that a number of individuals are rushing to his defense and saying, right now, we do have a lot of faith and backing of Mitch McConnell. Potentially, they want to see this through the end of the presidential election. Remember, Mitch McConnell is not just whether you like him or not. He is a very successful legislator in what he does on the Senate. He has immense institutional knowledge. His super PAC is also the biggest when it comes to money. So he is prolific when it comes to raising for the GOP. So right now, there's no out and open calls for him to step down. But potentially, this is something we need to watch, because these are serious health concerns.
4 Johns, potentially. No one needs that. No one needs that.
Are you making an announcement?
Nobody needs that.
Okay.
Anne-Marie, let's talk about crude. $90 a barrel.
Highlight of the show.
No more nightmares.
Carry on.
AMH crude, $90 a barrel.
The senator from London.
Yeah, that could work. What's the White House saying about this move in oil? Jet fuel starting to pressure the airlines. Could complicate things.
Well, gasoline prices is something that Jake Sullivan spoke about yesterday. He was on the podium previewing the president's G20 trip, and he was asked about this because you have Saudi Arabia, an ally, and Russia cutting, and the Saudi cut is just more prolonged, and we saw Brent crude go through $90 a barrel. Gasoline prices in America are already inching up towards $4 a gallon. This is a huge concern for the administration because we're already over peak driving season, right? We're post Labor Day, and you see these prices go higher. This is something that's a huge concern because what you see in the polls is Americans are continuously worried about higher inflation and give the Biden administration poor marks when it comes to the economy. So this is something, Jonathan, that has been the bane of existence for the Biden administration last summer, and going into the fall, it's going to be one of those headaches.
AMH, thank you. Anne-Marie, down in Washington, D.C. To AMH's point, it's quite rare to have gasoline prices where they are at this time of the year, coming out of summer, going into fall.
And that's a real concern, especially going into the election season. If they're increasing at a time where people aren't driving, they're supposedly staying at home, then what does that mean to come, say, December, when people travel around for the holidays? What does that mean early next year? And even more importantly, during the election? It's going to be a big issue.
Ever had shingles? Brutal. I've had shingles.
You've had shingles?
Super severe.
Isn't it related
It's horrible.
to chickenpox?
I had quite a mild case of shingles, and as you get older, it can be very risky. So brutal, yes, but A, I remembered where I was, and B, I wasn't trying to run the government. And if you don't know where you are because you've had a case of shingles, then are you fit to be in a seat in the Senate?
You know, I've been hearing Nikki Haley talk a lot about this. She's been out front. She's the Republican candidate for president, and she's been talking about the need for competency tests. There's a lot of research around whether or not it's even constitutional to do that. Will there be a push by a lot of standing ranking members that already are older to instate different measures that could put some sort of check on this?
And once again, Washington, D.C. finding themselves on the wrong side of the mood of the rest of the country. Because the rest of the country would like these kind of things to happen.
Are we looking
based
for
on polling?
Another John leader?
What,
in
Senator?
The Senate? Yeah.
Yeah, no.
More Johns?
No.
No?
From New York. This is Bloomberg. Viewer writes in, I don't think you're liberal enough to win the seat in New York. It's kind of brutal. I mean, they don't know my politics.
No clue.
No clue.
You were talking about being the fourth John in the Republican Congress.
Yeah.
All right. Well, it's true. Nobody knows you.
No, of course not. Equities right now on the S&P look like this. Futures. Keep it together, Bramo. It's rude.
Carry on.
Futures on the S&P, negative by 0.2% on the S&P 500. On the Nasdaq, we're down here by 0.2% as well. The Russell, tough day yesterday on the Russell. Small caps getting hammered. Not bouncing back this morning. We're down by 0.1%. Tough couple of days for the Treasury market as well. Switch at the board and get to the bond market. 2-year, 10-year, 30-year. 10-year yields lower by a couple of basis points at 423.81. The previous 2 days had a 16 basis point move in 2 sessions on Treasuries. I get it. Really busy day for corporate issuance in yesterday's session, pushing yields higher across the curve. And there are days when you see that, Lisa. You start months like September, you get tons of supply from the corporate side and it kicks around the bond market. But it was Friday too, and there was a rally in crude that got everyone's attention, and you wonder what's really taken us here.
Especially if the shift has to do with this increasing, I don't want to say consensus, but less contrarian than it used to be short bet on bonds. If you do think the Fed is going to use every excuse to remain on hold, and you see longer term strength percolating out, well, then all of a sudden real rates start kind of creeping higher in the face of that.
Let's talk about that move in crude. Crude looks like this morning, $3.90 for the first time since November. Brent crude this morning down by 0.6%, $89.46. Some warnings about how high jet fuel prices have gone over the last couple of months, 20% higher since the middle of July, according to United Airlines. So United with a warning, higher costs, a warning from Southwest, a warning from Alaska Air, all of that later in the last 90 minutes or so.
Would you fly the same routes if the prices were 20% higher? Is it sort of the price sensitivity that's going to drive people's travel, or is it going to be just the desire to still get out there? I don't know the answer to that. And that's sort of one of the key questions underpinning this. Are they going to take that 20% move and just say, actually, that's the reason why we've got to charge you more, sorry. And by the way, reduce the number of flights going in and out so we can jack up prices.
Is business going to make a comeback, one? And is the revenge spend going to continue? Two, on the second one, I do wonder, because we were getting told by domestic airlines, domestically focused airlines through earnings season, that maybe things were flagging a little bit and they had to soften fares domestically here in the United States. The international stuff, I've got no idea. I think a lot of people have seen those things on Instagram, Italy, Greece, what's happening in France.
They saw them 2 years ago.
They want to go on vacation. They want to go on vacation. Didn't we get that in the consumer confidence survey? Didn't they say their intentions to go on vacation were much higher?
To go on vacation.
I couldn't work out whether that was real. If they're actually going to spend that money on vacation or they just want to. There have
been stories about how cruise liners are getting pushback from different cities. They're saying that they're just mobbing all of the ports and that it's just getting a little bit out of control. So, which I totally agree with, by the way.
I couldn't agree more. You want to trash cruise lines? Let's go. I'm always ready for that.
I'm not going to trash them. I'm just going to say there are towns that are starting to try to restrict some of the foot traffic just because it has been so high.
As they should. As they
Oh,
should.
man. You are in campaign
Never
mode.
doing a cruise. I hate it when the cruise ships rock up. They spoil the view. You ever see that?
Yes,
beautiful
yes,
port,
yes.
great, fantastic
You're talking
view.
about somewhere in particular?
Yeah, beautiful boats in the bay, some of them docking, lovely, gorgeous stuff. And then this massive thing, this tanker with a hotel piled on top of it.
And all the people come out.
Pulls
and
up
they
and
mob
just
everything.
spoils everything.
You know, I think that if people like cruises, all the more power to you. I think that there's just an issue of how much longer people can keep doing this and whether they can keep jacking up the prices.
How much longer they can keep cruising. I agree. Under surveillance this morning, Japan's government defended the yen verbally after the currency set a new 10-month low. The Vice Finance Minister for International Affairs saying, quote, if these moves continue, the government will deal with them appropriately without ruling out any options. Now, Lisa, my question on that would be, OK, what are you going to do about it?
Which is the reason why you didn't really see much of a move. The move was very short-lived. My favorite was this one FX strategist who came out and said, we have jumped from level 4 on our verbal intervention scale straight to level 6 or 7, and a warning of imminent FX intervention, and markets don't care. I just think that that's really telling in terms of where people think the follow-through is going to be.
Pushback not just from Japan, pushback from China as well. A record-setting rally in China's property sector on bets the government is preparing more stimulus. Evergrande closing up 83%. I know it's basically a penny stock, but still, what a move, making it the largest gain since its listing in 2009. China's recent property developers still reeling, however, from deepening financial problems. So this ain't over, but that was quite a squeeze overnight.
Yeah, my favorite part about this is bad news so bad that it's good over in China developers. Is this basically looking at the fact that you could have a defaulter candidate pretty much across the board in the majority of developers in China, and that's being viewed as a positive because there's no way the Chinese authorities are going to let this happen. To me, highlights just how much people believe that China's assets have been beaten up. And just like Leland Miller said, maybe it's not as bad as people expected.
Is China in focus for the Europeans as well? The largest economy continuing to feel the brunt of poor demand from China. More disappointing data out of Germany. Factory orders plummeting nearly 12% to start the third quarter. The drop far surpassing the 4.3% expected in our survey here at Bloomberg. Difficult day for Germany. So yields higher off the back of some hawkish ECB speak. The DAX lower off the back of some pretty weak data and some concerns over in China as always. Lisa, what to do with all of that?
Germany is in a really tough spot. And I think everybody really would agree with that in the sense that their factory orders are down, probably in part because of China. They're probably the most exposed of the major European economies to China. And at the same time, services also not coming back, actually diminishing. Where is the growth going to come from at a time where Germany still has continued to really push into China? We saw that shift in tone from Mercedes recently, which I thought was interesting, shifting away a bit from China and saying maybe they aren't going to rely as much. That's new. And how much is that coming from the government?
The boom is over, based on that interview with the Mercedes CEO.
Which boom?
The boom in China specifically. I think what they underplayed was the competition domestically in China. You know, when German manufacturers just had it their own way all the time, that seems to have changed a lot.
Well, pretty much for
Where's the leadership been in German manufacturing over the last decade or so?
They are between a rock and a hard place because right now, based on where they are, they can't really change without torpedoing the economy entirely.
Allowing a sports drink manufacturer to dominate Formula One in the way they have. You know?
Is this personal?
No. Sonia Martin joins us now, Head of FX and Monetary Policy at DZ Bank. Sonia, wonderful to have you with us. I want to talk about that hawkish ECB speak from two officials a little bit earlier this morning. Is there truly some two-way risk in that ECB meeting a week tomorrow?
Good morning. Yeah, first of all, let me just quickly state that as a passionate sailor, I agree with you that cruise ships are an abomination.
You're welcome back anytime.
Moving on, but moving on to the ECB, what we have seen is a lot of division in the council. So, for a long time during COVID and the last year, we saw the council, unusually united, but that has changed completely now that we're nearing the end of the rate hike cycle. And you see the hawks and the doves sort of, positioning themselves. And I wouldn't really count too much on what individuals are saying right now, simply because there's a split in the council and they're sort of each talking their book. And that's what we saw this morning. I think the ECB is still very much split on what to do next week. And I think it's a bit of a 50-50. And this is what the market is pricing in on whether they will actually hike one more time. We don't think they will. But of course, there is a risk given that we still have quite high inflation. But as you pointed out, I think earlier on as well, we have a lot of weakness in the economy coming through, and that's something they'll have to keep in mind.
Sonia, how much are they watching and focusing on the euro and the foreign exchange transmission mechanism at a time where you have commodity prices going up, you have a stronger than expected U.S. economy, and suddenly the euro, again, is struggling to climb out?
Yes. Generally speaking, obviously, in this sort of environment, you don't necessarily, in terms of the inflation outlook, you do not want a weaker currency. For the export market, it's of course good news. I don't think we have to particularly worry about the level of the exchange rate in the Eurozone at this particular point in time. We have been trading 110 plus minus big figure for quite a long time now. And I don't think it's something that the ECB is overly concerned with. That might change should the euro continue to deteriorate, but it would have to be an aggressive and fast move. And I think we're miles away from this at this point in time.
Why is there such a push toward hawkishness? Is there a sense, or at least hawkish rhetoric, at a time where a lot of people had priced out a rate hike next week? Is there a sense that financial conditions are not tight enough, despite some of the moves that we've seen in yields?
Actually, I think it has to do with something else. I think, figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks. But it's really a lot more difficult right now than it was in the past because of the experience we've had in the last year with this incredibly high inflation. So I think what they're trying to do is strike a balance. On one side, they should signal the end of the rate hike cycle, either that it's already there or it's coming. At the same time, I think they do really want to keep the door open for additional tightening should that be necessary. So they just don't want to shut the door. So the combination, the compromise could be still quite hawkish rhetoric combined with, we'll wait and see what happens. And I think that's the most likely outcome next week.
Sonia, how much can I read into what's developing in Eastern Europe with central banks like Poland potentially reducing interest rates? Sonia, as we know, some of these countries actually led the tightening cycle before places like the ECB, the Federal Reserve, got going. Do you think they're leading the cuts as well?
Well, there are, as you said, a number of countries, also when you look at Latin America, that are already cutting rates, but they did start very early, and this is a different scenario for them. They've already done a lot, and they now have to retrace. I don't think that's a signal for anyone else per se. What it does confirm, however, is that we are seeing really the turning point in global monetary policy. And I have to say, I find it kind of bizarre that we are so incredibly focused on whether or not the ECB or the Fed will tighten one more time, because ultimately that is not going to change anything, is it? So why are we so obsessed with this discussion? Normally at this point in the cycle, what we would be talking about is the potential rate hikes next year, but that doesn't seem to be happening. We're totally focused on the next 2 weeks.
So some people are talking about the potential for that to develop. Citi's Andrew Hollenhorst at the Federal Reserve talking about that. Neil Dutta of Renmark considering the potential that maybe things pick up again. Sonia, is that a conversation in any way, shape or form at the ECB? It feels like things are a little bit more split here at the Federal Reserve. Is it over at the ECB?
That discussion isn't happening right now, but it will happen. And I suspect, and when it does start to happen, it will take some people by surprise. In fact, I would say that is also going to be the case in the US, because while the market is pricing in rate cuts next year, it's not something we're focused on right now. So what's going to happen, once we move past the next few months and we move into the winter, the economic downturn, it's really going to hit. And I think that's when people are going to start focusing on rate cuts. And I think that's going to create a lot of volatility in the market because, everyone's sort of ignoring that for the time being. So that is still very much in the pipeline for next year, not early in the year, more towards the middle of next year.
Sonia, thank you for the update and for your love of sailing and your hate of cruising. Sonia Martin there of DC Bank. Sonia, thank you. If you are just tuning in, welcome to the programme. Your S&P 500 negative here by 0.2%. Just a little bit of feedback out there, Bramo. The cruise thing is going to decimate your voter base amongst the seniors.
Well,
I think some people taking this a little bit too seriously.
Are there cruises that are more acceptable than others in your view?
No.
What about to remote places where small cruises?
One caveat. All right.
Okay,
river cruises, I think, yes.
River cruises are okay.
Smaller boats.
Okay, river cruises.
Smaller boats, more exclusive, more private, less disruptive to the environment and your surroundings.
No, don't even try to make this your environmental pitch.
Yes, absolutely.
You
Why
think
do you believe
so?
that? Yeah,
okay,
sure.
You think that the other ones are not sufficiently environmentally friendly?
I think river cruises are a lot more appropriate.
Is it because you're looking at one river cruise in particular in Alaska?
I would consider doing a river cruise. That would be, but I'd need all of my friends on the boat with me. That would
all right then, fine.
Exclusive.
Okay, there we go.
That's as far as I'll go.
Okay.
All right. I want to go back to the consensus view on the bond market. Can I do that?
Please
I'm going to
go for
do that. Jim Bianco Research. I'll go back to that quote. The contrarian players, short bonds, no recession, sticky inflation, no cuts in 2024. Isn't that kind of what Sonia was talking about there as well?
And that's where I was going to say is basically increasingly just on the margins, entering the mainstream discussion, you're starting to hear what happens if you get that real reacceleration? And to tie it into the commodities play, what happens if the increases that we've seen, not just in oil, but in copper and beyond, in iron ore in particular, less than copper, and also in food, is really tied to strength and demand and stickiness and inflation that's going to prompt further moves early next year that's going to surprise the market. That could be a real game changer.
My environmental concerns playing well in New York, just so you know. All right, AMH writes in, Rhine River Cruise. Rhine River Cruise.
Is she the one in New York who's actually
Anne-Marie
DC?
Would like to happen.
Okay.
AMH, a Rhine River Cruise.
Is that what you were thinking of? I thought you were thinking of the one in Alaska.
I like the idea of the fjords.
Yeah, the fjords are gorgeous.
It's beautiful. Yeah,
and honestly, it's hard to get to places and you see the sea life. I can get behind
If you've got a massive yacht, you'd lend me, to go and look at the
I'll try to drum one up. I'll see if I can pick one out of the jet stream.
Kevin Booker, Clearview Energy Partners, up next.
At the end of the day, we've had this just bearish onslaught of Russia news and of China news, and what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership.
Getting back on the show a week ago, Chris Ferrone of Strategas talking about crude, getting to 90, crude through 90 in yesterday's session for the first time since November. Just quite the rally that's developed over the last 2 months, Lisa. A 20% move on oil.
And why? And this is really the question. Is it just because of Saudi Arabia coming out and saying, and not just because, this is not insignificant, saying that they're going to continue with a 1 million barrel per day cut in production? Or is this something more in terms of strength that is underpinning this? I mean, I keep going back to Leland Miller. China's economy is doing okay. It just isn't doing quite as well as it previously had been expected to.
Just pulled up oil production in America on the Bloomberg. 12.8 million barrels a day. Just short of 13 million. And we're looking at prices like this.
A record amount of production that's fueling, supplies at a time where, there's been some speculation. Maybe people are using less gasoline because of electric vehicles, and that's why oil demand hasn't been going up as much as it should be. It doesn't make sense if you put it all together. There isn't a cohesive narrative unless there is some strength underpinning the moves that we've seen.
Kevin Book joins us now, Managing Director of Research at Clearview Energy Partners. Kevin, what is crude doing in the 80s with oil production in America at 12.8 million barrels a day?
Well, it's prospering. It's going ahead and reaching for the skies because some of the biggest producers in the world, other than the U.S., are cutting supplies to the world. And when you look at the Saudi Arabian and Russian decisions in recent days, I think traders are starting to finally take them seriously. Prince Abdulaziz, the energy minister of Saudi Arabia, referred to the 1 million barrel voluntary cut as a lollipop. It's starting to seem like an all-day sucker, a really long-lasting effect. And that's getting priced in now as well.
Kevin, they're talking up monthly reviews. Are you saying in that monthly review, nothing's going to change?
Well, nothing has changed so far. That is a caveat that leaves room for opportunity. I think the kingdom in particular is wary of crushing economic recovery wherever it might occur and stalling the economy generally, globally. But right now, it looks like there's still room to run. So no, we from the very start, if you looked at it, the $75 barrel worked backwards from an elasticity effect, it looked like it should have been about a $9, $9.50 per barrel impact from the $1 million cutback. The market didn't price it in right away, probably because it thought it was evanescent. But now that it looks enduring, yeah, sure, we're looking at a real premium.
At this point, though, how much is this also driven by the fact that growth isn't as bad as people previously expected in places like China and even Europe?
Second half of the year is always a bigger demand part of the year than the first half. My colleague, Jacques Rousseau, who you have on from time to time as well, he points out that we're looking at about a 4Q 2.1 million barrel demand ahead of supply. So that deficit is going to be pretty enduring. There's a lot of that demand concentrated, yes, in China, a lot of it in jet fuel. That increases the risks if there's some sort of hiccup over there, but it doesn't change the overall dynamic when we're looking at a sort of a seasonal effect.
There's also a question around what the bogey is for Saudi Arabia and maybe even for Russia. Is there a sense that they're trying to get oil prices to a certain specific level before they'll start to try to balance out some of their supply versus the demand?
Well, I think that there are two separate things that have to be taken separately. The kingdom is aligned with the Kremlin very explicitly as a matter of business, not politics. And if you look at the Kremlin, they've figured out that revenue is equal to price times volume. And if they're going to cut volume, a higher price works for them. The differences, though, are one country funding a war and another engaged in a very sophisticated and elaborate negotiation towards expanding the Abraham Accords. I don't think that the kingdom is looking to blow up that opportunity, difficult though it may be, and with many steps yet to come.
How important, Kevin, is it to refill the SPR? And how likely is it we're going to do that anytime soon?
Well, the Energy Department made it pretty clear, John, that there's not much interest in doing it at this price level. They pulled back from their requisition for 6 million barrels of additional volume. But how important is it? Look, that's a matter of opinion and perception. There are some who would say that the SPR was never needed, and especially not now in a world of shale. I've testified at least 6 times on the Hill that it's an insurance policy, and the insurance is cheap when you look at what it can do to prices to draw it when you need it. So I would be in the camp that it is worth refilling and should be done as soon as it can be affordably done.
So effectively, to build on what you've testified, we don't have that insurance policy right now, Kevin. So how vulnerable are we?
Well, we have 350 million barrels of oil in the SPR still, which is not trivial. On the other hand, what we don't have is the full carrying capacity of the reserve. And we don't have the clarity that conveyed when it was bigger. I think that was not only a message to the world about insurance against economic risk, but also a message to producers that if they didn't take up the slack and bring the market back into alignment, the U.S. would undercut them and take away their premium.
How awkward does this make the meeting between President Biden and Mohammed bin Salman of Saudi Arabia expected in the next few days or so at the G20 meetings?
I mean, I don't think it's going to get in the way of a fist bump. Look, the currency, the economic currency of oil trade remains the dollar, much to the chagrin of some who would think otherwise. The political currency of oil prices remains blame. The challenge for the White House is not just geopolitical, but also domestically political. The usual steps in the process of prices rising is for a White House to blame overseas producers, domestic producers. In this particular case, blaming overseas producers very much complicates the negotiation. And you saw Jake Sullivan yesterday very specifically avoid blaming the kingdom, as he and former National Economic Council Director Brian Deese did in October. And now at home, you also have producers, some of them aligned, at least notionally, with the White House climate agenda, probably not going to want to blame them, at least ahead of the Conference of Parties in Dubai. So maybe a little lighter on the blame and more room to talk.
Given that there isn't going to necessarily be a lot of action that necessarily comes from these discussions based on the unwillingness to really place blame, what is the offset? What is the off-ramp for oil prices going even higher? Why aren't we going to stay at these levels and go even higher from here for the near future?
I'm not sure you would want to bet against going higher, but there are obviously the economic fundamentals decay when prices rise. American drivers are pretty resilient. We can see that right now. On a trailing 12-month basis through July, though, we estimate that you're talking about some 600 plus gallons bought over the year through July by the average driver, more, by the way, in red states than in blue states. So there's economics and politics to that. The other side of it, though, is where you get more supply. Look, it would be difficult to say this, I think, from the White House perspective, but a certain amount of realpolitik is already at work on sanctions. The unspoken mini deal with Iran brings sour barrels to market. Sanctions leniency with Venezuela that could be crafted ahead of the election next year to induce democratic reforms. That, too, looks like another source of barrels. And maybe a certain amount of pragmatism in enforcing the price cap on Russian barrels to third countries. So there are heavily sanctioned countries where the White House can take a light touch. It looks like they may already be doing so or poised to do so.
Kevin, do you like cruises? That's all we want to know.
I like cruising in a car slowly down the street on a hot summer day.
Sounds
strapped
wonderful.
on a boat with nothing but food and booze, not so much.
There we go. We're on the same page. Kevin, thank you. Kevin Burke of
this?
Clearview Energy Partners. Just rounding up the team.
Now
getting everyone on the same page.
You realize you're making me want to defend the cruise industry.
I know, that's so on brand.
Which is, well, I mean, come on, that's how I think. So now I'm going to start looking for arguments against
you
that.
can do that.
Yeah, okay.
I want to bring up this currency pair right here. Dollar lira. Bang. What a move. Stronger Turkish currency. We're down on that currency pair now by about 0.1%. So that's in the Turkish lira's favour. This headline right here, maybe a leopard can change its spots. Erdogan of Turkey. We will reduce inflation with tight monetary policy. That's new.
Yeah, that is. I just immediately went to the profile of the new central bank governor, Hafiz Gaye Erkan, who's this young woman who came from Wall Street to really lead the central bank. And I wonder what influence she's having over Erdogan in this new reformed way that maybe you have to follow conventional monetary policy in order to have some sort of conventional inflationary outlook.
That headline from the Turkish leader just moments ago. It's amazing to see. I wouldn't say it's surprising given what we've seen develop over the last couple of months, but certainly surprising relative to where we were a couple of years ago.
Well, yeah, I mean, if you think about it, his response, Erdogan's response to high inflation was to cut rates because that was going to be the way to juice inflation. And anyone who disagreed with him was ejected from the central bank. So what kind of new shift in leadership is there to change this approach? And suddenly you're seeing downgrades to the Turkish outlook for growth. What is this?
I used to sit down with the central bank governors of Turkey, and I always used to say that they had the hardest job at central banking because these were some highly credible, intelligent individuals in that seat a lot of the time. And you knew what they wanted to do, but you knew they could only go so far. It was such a tough seat to be in. That move right there, dollar lira, 26.76. David Leibovitz of JP Morgan Asset Management is coming up next on this equity market. The rally stalling just a little bit. Futures negative 0.2%.
We have an unsustainably strong economy still.
Yes, things are slowing, but they're not collapsing.
You shouldn't be underweight equities at this point in the cycle.
Everyone keeps saying, let's be bullish the bond market, but look at the price. Look at the price all summer. It has continued to go up in yield.
Bad news is good news when it's just a little bit bad.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Alarian writes in, Nile River Cruise.
I could get behind that.
That's the last of the cruise chat this morning. From New York City,
No way.
good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK with a day off. He's going to be back tomorrow. Bad news is good news, so long as it's just a little bad.
I love that quote. It's
okay,
just
Steve
fantastic.
Chevron of Federated.
This is where we're at, is that basically you could have something that softens the outlook for the Fed, but not enough that you actually get the hard landing. So if you have growth, but you have a Fed that just to right-size things cuts rates, that's the Goldilocks that was the narrative, I would argue, a couple of weeks ago, but seems to be shifting a little bit on the margins.
Is $90 crude bad news or good news?
It depends why. It seems like people are trying to parse who it's good for and who it's bad for. I would argue for the Federal Reserve, it makes it very complicated. And I think that the airline industry very much highlighting that, coming out this morning and highlighting the increase in their costs tied to diesel, tied to crude. How much does that really end up getting passed along to consumers who just have to eat it?
Let's get those airlines up and have a look at them right now in the pre-market. Southwest is down by about 4%. The note that we got from Southwest, I think, was pretty interesting, Bramo, that essentially they're all coming out saying the same thing. Fuel prices are up. But Southwest also said they continue to expect solid profits in the third quarter and full year 2023. So to your question, do they eat it or pass it on? Are they kind of telling you what they're going to do there between the lines?
That basically if they're going to continue to see robust profits, and you saw a similar thing from United, that they're not going to downgrade their full year forecast, they're going to maintain it. Does that mean that they are going to pass it along? We saw yesterday United cutting the number of flights that it was going to be operating domestically out of Newark, in part because there was less demand. So you just reduce supply and increase prices. I mean, are we going to see this kind of activity rather than actually seeing the discounts?
So are we getting lower fares or not? Because I thought we were getting lower fares domestically.
There was a story in the Wall Street Journal talking about $20 fares. I couldn't find them. I quickly went online and quickly looked for a couple of different routes that I personally was interested in.
And your line, not theirs, was that these are cities that people don't want to go to.
No, it's not their line. That was your line trying to infer what I was implying. But I'm just saying the less popular routes.
Okay.
That's
another way of saying cities that people don't really want to go to.
Well, there isn't. Okay, moving on. There is a question here of some of the domestic cities and the routes there, whether it's, the mid states in the U.S.
Picking on Ohio a lot this morning, weren't you?
I'm not.
If you're just tuning in, you missed that. Picked on Ohio a lot in the last couple of hours.
Really, you're just trying to start trouble. You're just trying to distract me.
Maybe my Senate seat might be in Ohio. Or maybe not. Futures right now on the S&P.
Where are
Slightly
we going
softer,
with this?
negative 0.25%. TK's away.
So we have to go.
Someone's got to go a little bit crazy, right? And the bond market yields a little bit lower by a couple of basis points here. 423.61. We've seen quite a move over the last two sessions. 16 basis points higher across Friday and Tuesday. Underpinning that move, tons of supply from the credit market. I'll speak to Amanda Liner with Goldman Sachs about that at about 9:30 Eastern time. But also, you can't overlook this move we've seen in crude. We're talking about a 20% move from mid-July to where we are right now. Just a bit softer on the session to 86.45. Right now on Brent, Lisa, 89.63.
And how much further could it go if you do have some sort of unilateral resolution from Saudi Arabia that they want to get prices higher? And it seems to be going through. And you don't have the SPR, the Strategic Petroleum Reserve, or what do you call it, the Strategic Midterm Reserve?
Many people have referred to it as that, yeah.
If you don't have that potentially coming in as something, I do just want to say Cleveland to Orlando was one of the routes, and Detroit to Atlanta. This according to a Wall Street Journal article.
I love that you keep digging around this.
Well, it just raises this question, where are they? Because I was looking, for example, at routes to certain other places.
Places you'd like to go. Yeah.
They were a lot higher. They were still very expensive.
Okay. David Leibovitz is going to rescue you. Global market strategist at JP Morgan Asset Management. David, it's good to see you.
Good to see you.
Thanks for being with us. Let's talk about that wrinkle in the soft landing dream. It's crude. Back towards $90, just south of that now, through that level yesterday. How much of a problem might that be for this rally that's really stalled out recently?
So I think that the problem it presents is that it creates a tension between the growth story and the inflation story that creates this tension for the Federal Reserve. And so on the one hand, we're going to see headline inflation, which is what central banks obviously target despite focusing quite a bit on core. You're going to see the headline inflation number begin to move higher. At the same time, you have these higher energy prices, you have the resumption of student loan payments, you have a savings rate that has dropped relatively precipitously, and we wonder if the consumer is beginning to bend, not necessarily break, but show some signs of weakness. And this, again, creates a tension for the Fed. They want to make sure that they get rid of the inflation that's been generated over the past couple of years, but they're trying to do so without causing a recession. So their job has become infinitely more difficult given this move.
Bear with me here for a second. How important is it what happens with those extra oil costs for the airline industries? In other words, if you start to see them pass it along to consumers, does that shift the conversation at the Federal Reserve in a way that it wouldn't if it started to eat into margins?
So I think the airlines are an interesting story because they've had pricing power all along, right? As people have begun to re-engage with services and kind of put goods off to the sides, the airlines have said, we've been able to raise prices and people are willing to pay. I don't know why you would change that in this type of environment. So I think that they're going to continue to raise prices in an effort to defend their margins, but that's going to create an inflation problem. And again, at some point here, the consumer is going to need to make that decision. Do they go on the extra trip or do they hunker down and begin to prepare for a more challenging growth environment?
Do you sense a shift, and we've been talking about that this morning, from this consensus around a Goldilocks and a soft landing to suddenly something more in the Neil Dutta and the Katie Kaminsky camp of, hold on a second, what if the Fed does pause? And then they have to hike rates again next year, and all of those rate cuts that are getting priced in are absolutely off the table. Are you moving to that side at all?
So I think what's interesting, if we take a step back, is that at the start of the year, everything was going really well. Europe avoided a recession, China reopened and had a really good first quarter. The U.S. data was better than expected, and everybody kind of got this warm, fuzzy feeling that it was all going to be okay. What's happened more recently? China stalling out, Europe showing some serious cracks, particularly in manufacturing, and an inflation story that isn't really resolving itself the way that people would expect. I'm not sure that we have more clarity on, where we're going to be 12 months from now, but I think you're seeing investors begin to entertain the idea that maybe a soft landing isn't a guarantee. And I think that's what's causing market volatility to pick up here.
What I've struggled with this year, David, and we spoke to Steve Chevron about this yesterday. He said that when growth is scarce, you buy growth in the equity market. And I said, well, it's odd because we've had this growth rally year to date in the face of a series of upside surprises in the US economy. What is that about?
So I think that, somebody actually said that exact same thing to me yesterday. And so I got to practice this conversation. But I think
because they listen to us, David, that's why.
Exactly. But I think, the issue here with buying growth in anticipation of slower growth is that we had the AI boom over the course of the past few months. And so valuation is way off sides. If these were 10 multiple points cheaper on some of the big names, we'd be more interested. But given where they're trading today, it's a very difficult case to buy risk assets at a valuation that feels extended when you see some potential clouds on the horizon. And so we're leaning more into value. more defensive names, the dividend payers, and a big part of that is the price that we're being asked to pay to hold those assets.
Well, are we looking also at energy companies that are really going to be coming to the fore and actually becoming more popular?
So energy, I feel like there have been a number of false starts over the years where people get really excited about energy and then it kind of falls flat on its face. I do think that, the underlying businesses from an operating perspective are in much better shape than they were, say, 5 years ago. And so if you get that tailwind of higher oil prices, you get that margin expansion, and you continue to have this focus on returning cash to shareholders, energy could be one bright spot, perhaps in the short to medium term. And I think that's what makes this market so difficult to figure out, right? We're talking about a slower growth environment potentially in 2024, but we're talking about energy companies and airlines that have pricing power. And so which side of the trade do you want to be on? Are we going to get the soft landing, and do you want to lean into that cyclicality, or do you see clouds on the horizon and maybe we don't want to play it a little bit more defensively?
I want to ask you kind of a sensitive question. It's not about cruise lines, but I know that other people at your firm have been talking about the entire yield curve at 3% and everything going back lower. Are there any shifts or arguments right now within the team about this idea that you could have higher for longer and that maybe these higher longer term yields are here to stay?
So what I would say is that the dispersion across the research community of Wall Street is nearly identical to the dispersion of views that we have internally. There are lots of people in very different places. I think what the Fed would like to see over time is a positive real yield curve that slopes upward. So I'm in the higher for longer camp. And I think when they do cut, maybe they go back down to 2.5. Is 2.5 really the neutral rate in the type of environment that we find ourselves in? I do think that we need to be prepared for an environment where rates stay higher for longer. But I don't think that's a bad thing, right? Interest rates, that allows markets to do what they're supposed to do, which is differentiate between winners and losers. And that hasn't been the case for the past 15 years. So this could be a better environment for value, better environment for active management, better environment for fixed income, a world that maybe feels and looks a little bit more like the environment we were in prior to 2008.
So the bias is steeper curves?
I think so.
Okay, because we've just had a record, potentially. This came from Cameron Christ yesterday. 217 consecutive weekdays. In 06-07, this yield curve was in inverted territory. Yesterday was the 216th. So today is 217. Can you believe it's been that long?
It is shocking,
kind of nuts, right?
Especially considering the fact that people used to say, this is a sure thing for recession. Where is that now?
What do I read into that?
So I think this is the issue in the current environment. Right? We know all of the economic models broke during COVID. Forecasting is nowhere near as straightforward in this environment as it was prior to the pandemic. And so what you see amongst the investment community is just this very wishy-washy behavior where it's one side of the boat, then it's the other side of the boat. It's 40% of professional forecasters saying we're going to have a recession that then doesn't materialize, and now everybody thinks we're going to have a soft landing. I think what we need to recognize is
changed 5 times this year.
Right, the unprecedented nature of everything that's gone on, particularly the fiscal response. We don't have a playbook for that because we haven't seen a fiscal response like the one we saw to COVID in decades, frankly.
David, thank you. This was great. David Leibovitz of JP Morgan Asset Management. Lisa trying to get you to disagree with Bob Michael in a very subtle way.
Well, hold on a second. He basically was saying that there are disagreements, and this
should have heard what Lisa was saying in the commercial break about people who take cruises. Same kind of people who take McDonald's on airlines. That's what you said.
That is not at all what I said, but you know what?
Quote. You'd go with that.
Let's just go with that one.
If you're just tuning in, welcome to the programme. Your S&P 500 negative here by 0.2%. We're not meant to have favourites, but we do. Another favourite is Neela Richardson of ADP. And Lisa, she joins us in about 18 minutes' time.
I cannot wait to hear what she has to say in terms of those real gains that you're seeing in income. You mentioned that earlier, John, and I do think that this is one of the developments over the past few months that's really interesting and goes beyond just a temporary boost in spending because of what happened in the pandemic. This is really the question. If you get this could really prolong what we've already seen prolonged.
So all these headlines about cuts in tech, do you remember?
Yeah.
Over the last 12 months, and then just didn't see it show up really in the headline labour market data.
They were getting hired by everybody else. That was the whole thing.
Walking into other jobs, apparently.
Has that shifted? Because we did see that with the JOLT survey, which, by the way, everyone used to discount as completely imperfect and a completely non-scientific measure.
I know.
Back in the day. And now it's the key forward-looking indicator for what's going on.
Inflation expectations.
I personally I enjoy that. I enjoy that.
Do you?
One. Yeah, I do, because it's so.
Have you ever had the phone call from you, Mitch?
I have not gotten the phone call.
I've never had the phone call.
Still waiting.
Do you know anyone who's gotten the phone call?
I don't know anybody who's gotten the phone call.
If you have gotten a phone call,
I'd love to hear from someone.
Please,
if they've got
call
the phone
in,
call.
and we will patch you through.
Matt Miller writes in, 8 presidents come from Ohio. It's the most of any state in the nation. It's very upset with you this morning.
Okay, well, I look. I will just say, my father was born in Ohio. I have fun
that
thoughts
gives
about
you the
Ohio.
right to, yeah. Okay, sure.
I'm just talking about routes of airplanes. This is from a
I'm
story.
told that's tied with Virginia.
For what? Oh, in terms of the
most
presidents. Yeah, Ohio. It's interesting, though. I guess the swing state in between all the different things.
Is that what it's all about?
Rust Belt.
Uniting the country?
Yep.
Okay. Henrietta Trays of Vader Partners joining us next from New York. This is Bloomberg.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
As far as I'm concerned, the most important thing that the president is focused on is just trying to do everything within his toolkit to be able to get lower prices for consumers at the gas pump in the United States. It's really the price of a gallon of gas for the American consumer, not the question of which country's doing what here or there, that is going to be his ultimate metric for whether we're succeeding or not.
Okay, confused. That was the National Security Advisor, Jake Sullivan. I have no idea what all of that meant. Isn't the gas price higher in this country right now?
Right now it is, and they lowered it for a bit, and now it's going back up. It is.
So apparently I
lower.
shouldn't care what the Saudis and the Russians are doing. I should care about what's happening with gas prices, but gas prices are up. So shouldn't I care about it?
Okay, I was looking today at the prices, the AAA gasoline price level in the United States, and you could see that it is near the highest levels going back to later last year. It was higher, but still, this is unfortunate heading into a season that typically is not a driving season. We're going to get toward one. It could potentially shoot higher. Basically, they're trying to massage a message that is very uncomfortable for them right now.
Shouldn't you have been prepared to answer that question? That did not sound like an individual that prepared anything.
Have you seen any kind of cohesive remarks around the strategic petroleum reserves and what they plan to do, what levels are important to step in with? This has been a very tricky political issue for a long time, and now we're setting up for an election season where that SPR has been drawn down significantly, and it's unclear what levers you could pull other than to hope for a bigger downturn somewhere, but that's a sort of perverse hope to have.
Remember that fist bump?
Yeah. No.
That has worked out.
And we heard that there's going to be another fist bump, even
Is
though
there?
there's
I
some
missed
discussions.
that. When's that fist bump going to be?
Evidently, it's going to be in the next couple of days. There's going to be a G20 meeting between Mohammed bin Salman and President Biden.
I imagine they're not going to repeat.
I know.
that.
Kevin Book was saying that maybe they could.
Well, the Crown Prince probably should offer
This.
You know,
But then what if he offers this and it's not reciprocated? Then is it like game over and they cut
That's
production
pretty
by another
awkward.
million?
If you don't do that,
I mean, honestly, like,
I can't believe we're having this conversation seriously for a start, but yeah.
Carry on. All right, let's move on.
Henrietta Trays, Director of Economic Policy Research at Vader Partners, joins us now. Henrietta, we need to talk about the potential for a government shutdown. It's just not on the radar for people on Wall Street in a major way. Andrew Hollenhorst of Citi wrote this morning. Congress must act before the end of the month to avoid a shutdown. How avoidable is that shutdown, Henrietta?
I think the shutdown is quite avoidable. I've never really been in the camp this year that we're going to see a shutdown, mostly because I believe that Speaker McCarthy would look at the potential for a shutdown and realize that it's harder to turn the government back on than it is to keep it open. So I'm really concerned about the ability of Congress to create an off-ramp if they do shut down. And so I've gone back and looked. The longest shutdown on the books is 35 days. That was, of course, during the Trump 2018 to 2019 period. And that shutdown is basically what we would be trying to compete with. It's just for political purposes. It's just to sort of exercise demons and let air out of the balloon. And I'm afraid that it would have to be quite protracted. So I think that gives Speaker McCarthy quite a lot of impetus to reach a deal on a short-term agreement. That's what he's been socializing his members to for the duration of the summer, basically since late July, if I'm not mistaken. And so I think that what we'll see is a short-term kick-the-can sort of approach, which is, of course, what he did during the speaker's vote and then again during the debt ceiling negotiations. We're just prolonging the inevitable, which is the reality that Republicans do not have the vote for spending cuts at this time.
Dumb question of the day, Henrietta. Why is it that the House of Representatives isn't back in their seats until next week, even though the Senate's back up and running? And for the rest of the world, this is the week where the year restarts.
Right, exactly. So the Senate is up and running. They are ready to go, guns blazing, into 3 separate small spending packages. They have, of course, completed work on all 12 appropriations bills, which is the first time they've done that since 2018. Each measure is basically more bipartisan than the next. They are marching in lockstep. And I think a really important dynamic is to think about Minority Leader McConnell's health issues. He's going to want to demonstrate pretty remarkable competence right now. And I think that's going to give them a lot of incentive to move forward with, 89 and higher level thresholds on votes for those 3 small spending bills, plus the war in Ukraine supplemental funding request from the White House, which the Republican caucus in the Senate supports. And then the House is going to come back with just a litany of things that they're going to need to address. And they've only done 1 appropriations bill, so they're way behind.
At this point, we are heading into election season pretty significantly, and you could discuss it from the Republican side, which we have been extensively. But on the Democratic side, I'm curious how much of a headwind these higher oil prices that we've been talking about really are, considering that it was such a crisis last year when prices got to these levels.
What I've spent every election cycle looking at is when voters bake in their forecast for what the U.S. economy looks like. At the very earliest, you're talking about March, April of next year before voters start locking in their opinions of the economy. So right now, the potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time. Now, the understanding that inflation is high and gas prices are high is something that you see in the public discourse all the time, whether it's true or not. Right. You see, number 1 hit songs about how gas prices are high and the dollar doesn't get you to go anywhere. That is sort of baked in. But I don't know that this particular blip is going to be something that we need to overly stress about from the Biden camp.
Should we stress about the relationship or lack thereof with Saudi Arabia?
I mean, I think that you're going to see a lot of discussion of foreign policy, but Saudi Arabia is not going to be the number 1 talk. It's going to be China. And then after that, it'll be Russia and Ukraine. So I do think that that's occupying headlines right now. But foreign policy is notoriously one of those issues that American voters just do not pay attention to when it comes to Election Day. Obviously important right now, important for investors, especially for gas prices. But when it comes to actual voting, that's not how people turn out.
Out of interest, and I think this is interesting, at the next debate, you're going to see a lot of candidates from the Republican side on the stage September 27th who have said and may well say again that they're going to declare energy independence and they're going to see more oil production in the United States of America. And that conversation is happening at a time where oil output in America is very close to all-time highs. Now, Henrietta, is that something that this administration chooses to celebrate, ignore, or whisper about?
I mean, they sort of walk that fine line. It's the same with the border control debate. More people have been arrested at the border than we've seen in years. So I think it's that very difficult dynamic for Democrats, which are a big tent party where you've got to work with environmentalists, labor unions, business interests, free market economy advocates, the business roundtable. I mean, they really try to walk the line. So I think they say different things to different audiences. And I would say, as I've said before on your program, watch their actions. Watch what the administration actually does. To bring it back to China, where are the U.S.-China tariffs? Where are the Section 301 tariffs? Are they on at exactly the same rate as they were under Trump? They are. Are they likely to stay that way? Probably. So are you going to see various cabinet secretaries go over to China and try to, hold hands and start export control working groups and things like that? Sure. Are we simultaneously going to roll out export control restrictions that have never been seen before from the Bureau of Industry and Security? Yeah, we sure enough are.
Andrea, just quickly here, I want to finish up. You mentioned unions and some of the push that we've seen from President Biden. Today, he is going to be discussing some of the avoidance of the warehouse and the shipping strike that didn't happen and celebrating the union over there. I'm curious, do you think this is going to be an effective push for him in terms of reelection?
I do think that getting the labor unions back in the Democratic circle is critically important. So you'll want to see that with steel workers. You'll want to see that with autos. You'll want to see that with dock workers. Any labor union, they can speak to is where you see Ambassador Tai spending her time, Secretary Raimondo, et cetera. They are all trying to get as close as they can to as many labor unions as possible, because of course, that's where you've seen so much of the bleed into the Trump camp. Whether that's sustainable post-Trump is something that Democrats really want to try to avoid. So I do think that labor is top of mind for Democrats, always has been, and I know it is for very specific cabinet secretaries in that White House. And I think that's going to be a sustained effort that they pursue. And you'll see that as a dichotomy with environmental groups for sure.
Henrietta, thank you for being with us today. Henrietta Trays there of Vader Partners on the latest in the United States, the politics of Washington, D.C. In the next hour on Bloomberg TV, here's the lineup. Barry Bannister of Stifel and why he thinks we've seen the highs already for the year on the S&P. Richard Bernstein of Bernstein Advisors on why he thinks you're going to see a rally in the cyclicals. And Amanda Lynham of BlackRock, a timely conversation here as we see an explosion in corporate credit issuance to kick off the month of September. Well. It's just a tease. It's just a
explosion.
Just trying to
coming.
Tune in, all of that good stuff.
I'm looking forward to it.
Thank you. From New York, this is Bloomberg.
Well, we are looking at a little bit of softness, perhaps driven by this move that we're seeing in crude and concerns about what that means. Also seeing some weaker than expected data out of Europe, Germany in particular, lower by about 0.2% for the S&P, led by that crude level. This is Bloomberg Surveillance, and all morning we've been talking about oil prices that had reached yesterday the highest levels going back to November. We heard from Southwest, we heard from United, we heard from Alaska Air. They are concerned about some of the increases in prices, and then Delta came out with their missive of the morning that had nothing to do with oil prices, with the CEO saying that Tom Brady, a former star of all football teams, joining the airline as a strategic advisor. Bloomberg's Michael McKee is joining us for economic data. But Michael, do you want to comment on the fact that
I thought I was your strategic advisor.
You're going to be the strategic advisor for my Delta travels.
If you want to fly Delta because Tom Brady has a contract to come in and give speeches for them, that's good investment for Delta.
It seems to be working, at least for some streaming networks. We are getting some data on the margins with some trade information coming in a little bit, I believe, lesser of a deficit. Yeah. What's the latest on that?
Negative $65 billion, but this is July data, so it doesn't incorporate the rise in oil prices that we have seen, but it comes in a little bit higher than last month, because last month was, or the previous month, put it that way, June was revised down to 63.7. So all in all, probably not a whole lot of impact on GDP, but we'll keep an eye on what happens in the months going forward, because oil prices are obviously going to make the deficit worse depending on how much we're importing. We also have headlines, Lisa, from Susan Collins, the Boston Fed president, who is sounding slightly more dovish than she has, saying that the Fed may still need to raise rates, but maybe not in September. Here's a quote from her speech, which is just breaking now. I expect we'll need to hold rates at restrictive levels for some time, and while we may be near or even at the peak for policy rates, further tightening could be warranted depending on the incoming data. Patience will give us time to better separate signal from noise as we assess available data and to balance risks as the effects of tighter policy continue to work through the economy. So she's not a voter this year, but she is a well-known economist, so I'm sure her words carry some weight, and she just joins the parade of people, including Chris Waller yesterday, saying that we don't have to do anything in September, and I think you're going to get the markets to that point pretty quickly.
Are there any hawks left on the Federal Reserve?
Well, Loretta Mester was out saying that she thinks we need to maybe raise rates again, but she's also not a September person, so necessarily, she says. So I think when we get the CPI next week, if it comes in as expected with the core dropping, then the Fed is pretty much locked into not doing anything in September.
John and I spent a lot of the morning talking about the conversation that we had with you, with Patrick Harker of the Philadelphia Federal Reserve, where he was saying that anecdotal data might serve a better guide at this point than a lot of the hard data that people traditionally look at, really highlighting why we should care about the Beige Book, which comes out today at 2 p.m. I always care about it, but other people might say it's really boring and not important to care about. Do you think that this will actually be more telling in terms of the real-time indicators of how much higher rates are percolating through the economy?
I think it will give us a better picture maybe than we've had recently. You'll get views from around the country in the different Fed districts. And that'll be interesting because, as you pointed out, Pat Harker said in the Philadelphia district, he's getting anecdotal reports from CEOs that things are slowing down. Is that happening across the rest of the country? And is that going to affect people like Loretta Mester, who thinks we might do a little bit more? What's the balance of strength in demand versus supply? Do we start to see it out of balance? I mean, it was interesting. This morning I saw some analysis of the Atlanta Fed GDP now, which is at like 5.6, 5.9%. And everybody says that's not going to happen. But we could get, it was Steve Stanley at Santander said, we could get 3.6, which would be extraordinary.
Before you go, I'm curious, Steve Matthews of Bloomberg News came out with this story today where he basically said that Fed officials are poised to double their growth forecasts on the heels of some of these better than expected prints. And in light of what we're seeing with, you can castigate it how you'd like to castigate it, but Atlanta Fed GDP now seems to show there is a robustness that had not been foreseen at any point over the past couple of years. What does this do in terms of the balance of the probabilities of how much they could potentially raise rates further down the line?
Well, it's too early to say that they have to raise rates more than another 25 basis points, which was their forecast. We'll get a new forecast on September 20th, but it does suggest that they have gotten the forecast for the economy wrong, at least through the third quarter. And if we get strong growth, it raises supply-demand questions and questions about whether we will see more inflation. But, of course, the language that Steve used, double their forecast. Well, their forecast was for 0.5%. So if they double their forecast, they'll go up to 1%. And we were just talking about the possibility of 3.6. Then the question is what happens in the fourth quarter, because you've set a high bar, you've set a high starting point. And there are still people out there who are looking at this strong data and saying, yeah, but that means maybe even contraction in the fourth quarter because you can't keep rising at that rate.
I can't wait until tomorrow when we can talk about Barbie and Oppenheimer and how that boosted the beige book, particularly in Philadelphia, as well as Taylor Swift. Thank you so much, Michael McKee, as always. Joining us now is someone who always has incredible insights. We loved catching up with her over in Jackson Hole. Neela Richardson, chief economist at ADP, with a real insight into just how much ammunition, firepower a lot of the consumers have. And Neela, throughout the morning, John and I were talking about this real income increase that we're seeing across the board. And I'm wondering, from your perspective, how much is that going to fuel the next wave of consumer spending in a way that maybe isn't being fully appreciated?
Hi, Lisa. Good morning. Good to see you. Yeah, real wages going up is a great thing. It's a great thing for workers. But I think it's very important to provide context to that number because the thing about inflation, and I know this sounds very obvious, is that prices generally go up. But when it comes to core inflation, they don't come back down. And so we're still looking at higher prices from the consumer perspective. And where you've seen the wage growth is for predominantly low-paid jobs. And so that, by our estimate, is about $5,000 over the course of a year and a half of double-digit wage growth for this particular sector. $5,000 after tax doesn't buy a lot of eggs, oil, higher rent prices, and medical care. So you have to put this in the context of the consumer household budget as well.
It's really important to look at it that way, especially in light of what we've been talking about also this morning a lot, which is oil prices and gasoline prices, diesel, all of it heading higher and significantly so. How much is that going to crimp budgets in a more material way at a time where there already is heightened awareness of price sensitivity simply because of what we've seen and the levels that we've gotten to?
Oil prices going up, even for a short time, just complicates this narrative for the Fed, right? It's the one part of the economy we thought we've had under control, that higher oil prices wasn't going to spill over into transportation costs or goods production. But yeah, the specter has risen again. And so now we know even if the oil prices go down in the short term. They're always there, not quite asleep, and they could peak up. In terms of the consumer budget, we're back to school, we're back to work, we're back to commuting, and so those oil prices are not going to be something that consumers can skirt around, even if there's more remote work than there used to be.
And we were talking about this in light of some of the warnings from the likes of United Airlines and Alaska Airlines and Southwest saying that their energy prices have increased dramatically, which is not shocking considering what diesel has done. How much can they pass this along to consumers that already are starting to push back?
Yeah, that's tricky. Air flights have gone up. Consumers may have overdrawn their burst of revenge travel, and especially going into the fall, there's less of a holiday travel season. And so that's also a particular concern. Also, it's very hot, Lisa. I don't know if you noticed that.
I did notice that.
But in terms of energy costs, even late into September in much of the country, air conditioning is really driving up energy costs, separate from the airlines, but part of the overall consumer budget picture that allows for that wiggle room for travel. If you're paying higher energy costs at home, harder to make room for that last minute fall season travel as well.
Although I will say that recently, just anecdotally, talking about the Beige Book and anecdotes, I will say that going into stores, I've noticed that people are actually air conditioning less. And I wonder how much it's to save costs, because sometimes you go in and it's still really hot. Anyway, I digress. I'm wondering, from your vantage point going forward, a lot of people are looking at Friday's jobs report and saying it was Goldilocks. It basically gave the Fed a free pass to remain on hold. And then bond yields rose. They rose on Friday and they rose again yesterday. People saying it was technical. People saying it's because maybe the Fed would pause and then there'd be a reacceleration of inflation. How would you describe the labor data that we've been getting, both from ADP as well as from the government, in terms of, is it really Goldilocks?
You know, we're in a labor market that is, in some sense, Goldilocks. We're seeing wage pressures start to decline and moderate. We're still seeing solid job gains. But within that overall macro picture, it's a highly fragmented market. It's a market that has seen a lot of churn and continues to see elevated churn. And within all of that, there's a lot of inefficiencies. And so really, I think that the Fed's job now is much more complicated. When inflation was super high, it was easy to know what monetary policy was supposed to do. Now they're entering this period of fine-tuning, right? They're tweaking what the terminal rate should be. Maybe it's 25 more basis points, maybe it's 50, maybe it's a pause in September. There's all the spectrum of choice depending on what data you're looking at. If you look at the labor market, there is an argument to go stronger and there is an argument to pause. And it's just a matter of where you're putting the weight. Are you putting it on the unemployment rate? Are you putting it on wage growth? And that is going to be something that the Fed is going to have to feel out in all of this data.
What happened to all the layoffs, the white collar layoffs that people were talking about a year ago?
They never happened. We see initial jobless claims are still quite low. And this is still a very solid labor market, even though the unemployment rate went up to 3.8% in this last report. It was because more people came into the labor market, not necessarily because companies were laying off. And when we look at our data, we see still solid growth across sectors, even sectors that have struggled this year, like manufacturing. For sure, services are still seeing strength. And so, yeah, if you're looking for bad news on the economy, I encourage you to look elsewhere because the labor market is not the source of it right now.
Which a lot of people are saying is the reason why there is going to be ongoing strength. And we are seeing the potential for the Federal Reserve to increase their growth expectations. Just to give you a sense, we get initial jobless claims, of course, tomorrow. And then I am curious, early next week, NFIB Small Business Optimism Survey, how much you start to see smaller businesses experience a little bit of stress or not in terms of anecdotal evidence. If you're just joining the program right now, you are seeing the S&P lower by about 0.2%, now 0.3%, deepening the losses ahead of the opening session. A bit of euro strength, a reprieve after quite a bit of weakness, 107.39, and 10-year yields lower, just a touch lower, 4.24% after yesterday, the sell-off that we saw in treasuries. Neela Richardson of ADP with us here. And Neela, just on a personal note, I know that Tom is off. People are going back to school. Personally, I've got kids that are going back to school. Do you have a sense of whether the whole back to school spending is going to be as robust and, fruitful for the stores and less so for the parents as people had expected?
I on the consumer spending front, just generally speaking, we've seen consumer spending stay strong, but there's caveats around that in terms of excess saving that was built up because of relief payments directly to households during the pandemic. It's starting to wane. We're also entering this period where there's higher interest rates, so putting some of that spending on your credit cards is going to be more expensive than it used to be. I think really what we're looking at is seeing through the fall and into that holiday shopping season where there's more optionality about what you buy. Kids need clothes for school, and you can change like the labels, but it's hard to change the growing children in terms of new back to school clothes. But I think you get more discretion around the holiday shopping season. That's when 20% of retail sales show up in the economy. I'd be really curious to see how those higher interest rates bite that consumer spending.
Neela Richardson, always a pleasure, of ADP. Thank you so much. It is not an option to buy your growing children clothes. I just learned maybe what kind, but maybe not. Maybe the holidays will be the time when we can start cutting back. Coming up, George Ferguson, senior airline analyst for Bloomberg Intelligence, on some of the shifts in oil.
Gary Gensler's decision of sort of engaging this regulation by enforcement, rather than getting clear laws, he knows they're not clear. He just likes that lack of clarity so that he can go after anybody and make up the rules as he goes along through bullying. And that's not the American way.
That was Chris Larson, Ripple co-founder and executive chair, speaking with Bloomberg's Ed Ludlow. You can hear more of that later today at Bloomberg Tech, 12 p.m. in New York, 5 p.m. in London. We have been talking all morning of the airline industry and their response to higher energy prices and higher prices just in general for labor, as well as just generally the operations. What does this mean for prices? What does this mean in terms of potentially waning demand heading into the fall and winter season? George Ferguson joining us now, senior airline analyst for Bloomberg Intelligence. George, what do you make of the announcements and frankly the synchronized announcements from Southwest, United, Alaska Air about higher energy prices and not necessarily factoring into profits this year?
Yeah, so, we were actually refreshing our models yesterday and been watching fuel prices during the end of the summer. And, they were creeping up, and it was kind of becoming clear that there was no way they were going to make, I think, consensus earnings for this quarter. So I think the announcement is part of, these companies trying to start to warn the markets that things aren't going to be good as we all thought. I mean, really, coming out of second quarter, earnings were pretty good, especially for the full service carriers, especially for United, American, and Delta. And we really thought it would be a great third quarter for them. And fuel prices, have come up about 50% since then, really crept up on them. And pricing power, I think a lot of the tickets were probably already locked in because they were sold for summer. They were leisure travel, which typically has a longer lead time. So I don't think there was much room to move on fares. And like I said, we've been sort of busy looking at our models again, taking a lot of the numbers down. And I think this was trying to get to the markets to focus on it, that, hey, things just aren't going to be as good in 3Q.
So in other words, you think that the reaffirmation of full year forecasts from United and a similar kind of tone from Southwest is not totally accurate, and that this is the first step to actually downgrading some of the earnings?
Well, so I'd be surprised if the full year can hang in there if fuel prices stay here. I just don't see pricing power for the airlines right now, right? I think when we again look at our models for 3Q, really what we're seeing is we think yields are slipping, which is synonymous with fares. We think it's been a very leisure-driven recovery for the airlines. It's been a leisure bounce back. And so we just think that strength in fares can't continue into 4Q. We don't see business travel coming back. And so I just have a hard time imagining with the setup we have right now and higher labor costs for the full year to be able to hang in there.
How many of the airlines have actually hedged oil prices?
Not many, right? So the only ones that really hedge oil prices, Southwest has a decent hedge, so they've been hurt less. We see small amounts of hedging at Alaska and JetBlue, and the rest just don't hedge.
When you talk about the softening demand, there was a story that I was reading about, a number of stories, about how prices are starting to go down in airlines, even reaching 2019 levels, particularly domestic flights. And that's one characterization. How much is this isolated to domestic travel in the United States? And how much is this a broader softening that extends overseas?
So if you're talking about U.S. carriers, I think that a lot of them built in pricing, again, for this summer. Everyone I talked to went to Europe, I think, for vacation this year. So I think everybody saw the strong dollar and booked their overseas flights. And that's why I think, 3Q looked better for the full service carriers, because a lot of those tickets had already been sold. I think once we get past the summer season for the U.S. carriers, that long haul demand just isn't going to be there in the strength that it is right now. And so I think fares will absolutely soften there. And like I said, we've already seen the domestic starting to tail off. I think that some of the domestic consumers not as well heeled. They couldn't afford to pay the higher prices. And in 3Q already, we had the airlines starting to warn us about yields and they're seeing some weakness in that demand. I think overseas, for overseas carriers, when we talk to people in Europe, I think a lot of the even the European carriers were seeing their demand from U.S. consumers. One of the interesting things I've heard from I think European travelers is the cost of dinner in New York is really expensive, so there's not much value for coming to this side of the Atlantic. And I think that was putting a bit of a damper on demand when it comes to, long haul out of Europe. Again, I think the U.S. consumer was holding up a bunch of that. Asia's still reopening. Asia fares are really high, but capacity is starting to leak back into that market. And I think fares will come down to Asia, but the capacity constraints right now just keeping fares.
I love it, George. All the trash talking on both sides of the Atlantic. On one hand, it's so expensive in New York. On the other hand, have you seen how crowded the Uffizi is? I mean, honestly, you're getting out on both sides. There is a question, though, George. You did say that you don't see business travel returning. We have heard that it has been coming back and that people are going back to the office. What's the latest in the thought process around what comes back and at what levels? Is this really just an issue of people not traveling or companies not shelling out for business class?
Yeah, so, it's always, this is a hazy part of the market we always sort of probe through, try to figure out what's really going on. I think that with return to office coming this fall, it seems like at least some industries, especially the financial industry, pushing a little harder to get people back in the office. I think that's going to improve, business demand. We've still seen it between sort of 65 and 75%. So it hasn't fully returned. Some interesting anecdotes we hear from the field is like, the consulting industry. Consultants just not going and working on site anymore, working from home, right? And so some of that may be because people aren't back in the office, so why bother bringing the consultant back? Consultants are a big part of, airline spend. So I think once we start to see return to office, then I think we're going to figure out if something like the consulting industry follows suit, goes back to working out of companies' premises. But I mean, you can imagine that if there's an economy there, if the consultants go to companies that they're working for and say, if you don't want the consultant in your office, it'll save you some money. We may never see sort of business travel get back to 100% of what it was in 2019. But again, look, things morph, and so there'll be other business travel that backfills. But I still think we've got a bit of time before we get back to even 80-90% of 2019 business travel.
Before I let you go, George, I do want just your take on a controversy this morning on Bloomberg Surveillance about why certain routes by certain airlines have been increasingly discounted by certain airlines. There was this story in the Wall Street Journal about $20 fares from Cleveland to Orlando, from Detroit to Atlanta, flights that are as cheap as $115 from Mexico to Central America. Why do airlines discount certain routes more than others?
It's all about competition, right? And so, I think everybody likes to think that United and American Delta full of business travelers, Spirit, Frontier full of ultra low-cost leisure travelers, but there's a mix inside of every airplane, except for business travelers in Spirit and Frontier. And so, if Spirit and Frontier show up, for example, in your marketplace and you're Southwest or United, and you feel like they're hurting fares in that market, you may abnormally lower your fares to even loss levels just to try to drive them out of your marketplace. It's all about competition.
Any travel coming up soon, George?
Yeah, I'll be over in London for International Society of Transport Aircraft Traders. Always a great conference in the beginning of October.
Well, we'll catch up with you on your experience traveling there, as well as what you gleaned. George Ferguson of Bloomberg Intelligence, thank you so much for being with us. Coming up on Bloomberg TV at 2:30 p.m. Eastern, Armen Panosian, new co-chief executive officer of Oaktree Capital, at a time where there is an increasing amount of money going into private capital. This comes as there is suddenly a renewed appetite by companies to sell debt. We are getting word of yet another debt sale on the slew that we saw, the barrage of corporate debt sales yesterday that some people say was kicking around the Treasury market a significant way. There's a $3.7 billion debt offering for the Syneos buyout coming out. So it's not just investment grade, it's also high yield. Some $40 billion of debt sold yesterday. The expectation is it could surge to the highest level this week, certainly of the year, if not for quite a bit of time, as companies start to grapple with how we deal with higher rates for longer, whether we lock them in. Right now, we are seeing crude come down after yesterday hitting the highest levels going back to November. We are seeing that cut from Saudi Arabia, from Russia, percolate into this feeling that maybe the U.S. and frankly the China economy as well isn't as weak as people previously thought. Today a little lower, $86.31, but still substantially north of that $80 front on crude traded on the NYMEX. We also are seeing yields basically going nowhere, 4.24%. This is Bloomberg.